here you can simply, document the distribution of this personal guarantee for different degree of specialization. If you see that they concentrate, this is actually showing that these banks are not exploiting information, but they are concentrate in a markets where they are risk-loving, and they pass the risk to the borrower that cannot default. If instead you see that they don't use it, this is very good for your story because they have superior information. If you don't see a difference, this is also good because then you can say, conditional in having a guarantee, are they still performing better in terms of PDs or the AUC advantage? So how much time I have? 2 minutes? Okay. So the last 2 comments that I have is, well, complementary susceptibility. This, again, is a cheap comment, but I think it's relevant. We want to understand whether sectoral specialization and local specialization works together or not, and how they are related on relationship. Unfortunately, you didn't manage to go over these results, but they are very interesting, believe me. So here you can simply have, standard interaction, understand whether you have stronger performance for lower degree of the interaction, either on sectoral specialization or relationship lending. This is a sign that they work as substitute. If they go hand in hand, stronger performance when all of these levels are high, this is a sign of complementarity. And finally, minor comments, but relevant, since you show that these effects are so huge and so good for the bank, why not all these banks are specializing in one sector or in one municipality? So here I would like to see how the portfolio volatility of these banks differ in terms of their degree of specialization, what types of banks specialize and which not, just to have a better understanding of how this is related to the size of the firm. And finally, you give a lot of evidence on the firm side, but are these, on the bank side, but are these firms squeezed or not? So why don't you explore firms' profitability, conditioning on the size, and understanding how the match works and whether they benefit or not. So again, thank you very much. Very nice paper. I really enjoy reading it. I really recommend you to read it. I hope to see the new iteration soon. Okay? Thanks.
Thank you very much, Gianmarco. Do you want to answer very briefly?
Yeah, very briefly, because I know that we are going to be able to talk a lot about this. Yeah. So thank you for the discussion. Thank you for reading the paper and all the comments and suggestions. So regarding this endogenous problem, it is true that in our identification strategy, we already control for local factors and sector factors, but it is totally true that exploring whether banks specialize in areas with high or low default probabilities, I think that would speak into the endogeneity problems that we might have, so we will do it for sure. We have in our to-do list also to exploit these mergers and acquisitions, also branch closures. That's a good idea as a possible source of exogenous variation and specialization. In terms of the mechanism, that's totally true. We don't have a long sample period, but we still can find some shocks to try to address which is the exact mechanism behind our results. And we also could use these PDs because they are updated quarterly, so we could examine that. And the last thing I want to say is that we did some analysis on the interactions between local and sector specialization, because there is also a paper by Daniel with people with economists at the Central Bank of France, where they find that that is important. In Spain, it doesn't seem to be that important, at least in terms of loan default, but we will explore deeper the relationship with relationship lending, because that might be something relevant. And this has also been highlighted before by Manuel Arellano also, when I presented the paper in another place. So yeah, thank you so much for the discussion.
My pleasure.
Okay, so now we have some time for questions from the floor. Please, can you bring the microphone over here? Yes, can you bring the microphone over here? So Rafa.
Okay, thank you. Now, you focus on the borrowing firms. What about the lending banks? Is specialization a characteristic of smaller banks? The top 3 Spanish banks, I presume they lend to all sectors in all locations.
Can I answer, or should we take more?
How do you want to do this? Okay, so let's take 3 questions and then you can answer. Javier.
Thank you for the presentation. I think that, well, as I see this paper at the moment, the results are highly exploratory. I would like to get some clarifications on the following. So I was a bit confused in your introduction of the topic on whether you are considering a world in which a specialization of the lender affects the probability of default of the borrower, say through monitoring. So monitoring has the capacity to alter the probability of default of a given borrower. Or in contrast, you are just considering that the lender who is specialized has a greater capacity to predict a given probability of default. I think these are very different worlds that will require very different empirical strategies. They are not necessarily incompatible, so you might have a mixture of both things. Then when you consider the regression in which you say the dummy for default equals 1 if a loan ever defaults, I'm a bit worried about the variation in the horizon there. So why not to focus on predicting probabilities of default within 1 year, which is the horizon consistent with the estimate of the PD, and do that on a rolling basis, because otherwise, I mean, maybe observing a firm over a longer horizon is already telling you something about the viability of the business or the relationship in the background. You have a strange result, you say a strange result that micro firms' specialization is associated with higher PD, right? You say you still have to interpret what is going on there. But this could precisely reflect what is a specialization about. So it could be that a lender is specialized into treating distressed firms. So instead of searching markets where PDs are low, is actually specialized in dealing with firms that have a higher probability of default, but may still provide you good lending opportunity. Okay, so I see like a lot of potential questions to answer going forward. Thank you very much.
Have time just for one more question.
Thank you very much for the presentation. So I have one question made of 2 parts, but one is related to Rafael, and it's simply, I don't know if you're able to with the Spanish credit registry, but what if you remove the top 3 banks? I was thinking this might be related to the result about lending that you couldn't explain. And the second one would be more like about the estimation bias of these PDs. So once you compare them, whether you get different results if you use 2 subsamples. The first one including the COVID and the second one including instead the tightening. This is more just, I think it would be interesting for, many theories about.
Well, so thank you very much. We are out of time here, so maybe you can...
I will answer later to all of your questions. Thank you.
So now we are moving to the second paper in this session, which is about bank supervision and non-performing loan cleansing. So, Serafin, please.
Yes, good morning, everyone. Thank you very much. Can I have both? Yes, great. Yeah, thank you. So let me also thank the organizers for the opportunity to present this paper, which is titled Bank Supervision and Non-Performing Loan Cleansing. My name is Serafin Tsoukas. I'm the University of Glasgow. It's co-authored with Soner Baskaya, who is also based in Glasgow, and with my 2 good colleagues from co-authors from the Bank of Spain, Jose Maria Serena and Jose Gutierrez. They're both here, and I thank them very much. So let me, well, the usual disclaimer applies, and let me start with a little bit of background and motivation behind this paper. So what is generally accepted is that following extreme economic events, financial crisis, etc., banks tend to accumulate large levels, large amounts of non-performing loans, the so-called NPLs. Now, this is quite problematic because not only high levels of NPLs harm the balance sheet of the banks, the high levels of NPL can negatively affect the economic activity. They can, slow down the post-crisis recovery, and generally speaking, it's undesirable for the overall financial stability of the banking sector. Despite that, banks have a discretion in how they manage non-performing loans, and they actually have an incentive to keep non-performing loans at inefficiently high levels. The main reason behind this incentive is that if they recognize the loans and if they provision for them, their short-term profitability, the short-term accounting profits will take a hit. For this reason exactly, supervisors have every reason to monitor closely the asset quality of the banks and whether actually banks manage non-performing loans in a timely way and very soundly. And in line with these, European authorities over the past years, especially in the aftermath of the European sovereign debt crisis, they have decided to undertake a number of initiatives to handle the non-performing loans of European banks. Again, the idea here is to strengthen the NPL supervision and make sure that the loans are handled appropriately. However, despite the importance of these policies, there is very limited evidence about whether such policies are actually effective in reducing non-performing loans and whether they may improve bank lending. And this is somewhat surprising, and to some extent this is one of the main contributions of our paper. What we wish to do is to use very granular data and analyze how supervisory guidelines, rather than legally binding requirements, can shape banks' actions. And as the previous paper by Alejandro, we rely on granular loan level data, so we rely on the CIR, and we match firms and banks. As I said already, the idea behind the policy initiatives that have been undertaken over the past years is to increase the provisions for non-performing loans. And the specific initiative that was released by the ECB, for which I'm going to give you more details in a minute, was, as I said, a legally non-binding, so it was framed as a non-binding policy. However, banks had to either comply or explain any deviations regarding the performance and then the disposal of bad loans. So having said that, the main aim of this study is to look at this policy intervention and study three interrelated outcomes. This is the disposal of the NPLs, the probability to dispose the NPLs, the dynamics behind lending, so what happens to the supply of lending, and then finally, we'd like to take this to the firm level and see what happens to the real economy. So these are the three topics that we're going to explore. And if I can give you a brief summary of what we find, we actually saw that the introduction of the ECB policy was quite effective in terms of ensuring that banks had a desire to dispose faster non-performing loans. But more than that, banks that were more heavily exposed to the policy, they actually tightened their lending. And not only that, they were requiring high levels of collateral. I will show you that they terminate bank relationships. So we find that there are actually effects at the bank level. And the third set of results, as I said, we will be looking at the firm level effects, and I will show you that for those firms that borrow from banks with older NPLs, then before the policy, these banks actually suffer in terms of their investment, their employment, and other real activities. And if anything, the effect is stronger for the riskier firms. So we do find that the policy had an important effect for the economy. Okay, so now I think I'm ready to introduce the relevant literature. Again, I'll be brief, but there are three key areas of work that are related to our study. One is the determinants of non-performing loans. So there's a number of studies that actually look what are the key drivers of non-performing loans. And the main summary is that it boils down to macroeconomic conditions and bank-specific characteristics as the key drivers of non-performing loans. Another line of work that is relevant to our study is whether there's a direct link between high levels of non-performing loans and bank lending. Again, there is evidence that shows that the two are related to each other, but it's really hard to identify causal relationship in absence of any exogenous event, for example, natural experiment, and proper control for firm demand, which is what we offer in this study. And the final line of work, which we think is probably the closest to ours, is how tighter supervisory interventions affect the supply of credit, although previous studies mainly focus on interventions that are binding. We are looking at a policy change that relies on guidance. And we think that this is important because it gives banks, some flexibility about the decisions that they make. So these are the key strands of the literature that are related to our work. So now let me take a minute or two just to introduce you to the policy that we are looking at. Let me remind you that the background, the main reason that banks decided to intervene, especially the ECB, was to help banks to resolve their non-performing loans. Post-European sovereign debt crisis, non-performing loans were at high levels, especially for the periphery zone, and they wanted to push for a discontinuation of the wait and see approaches. So they wanted to see this problem resolved. And that also added to transparency of the ECB about the way that banks treat NPLs. So following a consultation between banks and the European Central Bank, in March 2018, the ECB released the so-called non-performing loan provisioning guidelines, and that was a policy document that gave quantitative criteria about two dimensions of the non-performing loans that are critical. One is the time that the loan is spent in a non-performing status, which is what we call vintage. And the second criterion is the collateral, whether a loan is collateralized or not, whether it's secured or unsecured. So these two criteria are very important because, as I will show you in this table, which is taken directly from the policy document, quite unexpectedly, the ECB decided to focus, separate non-performing loans between secured and unsecured. For unsecured loans, the expectation was that they should be fully provisioned in 2 years' time, and for the secured loans, there was a stepwise provisioning starting from year 3 up to year 7. So these specific requirements, actually led the banks to act upon it, and it was a tighter and more specific guidance about how to dispose the vintage, the older NPLs, the ones that have been sitting on the bank's balance sheet for quite some time. And we show that these guidelines were issued as I said, in 2018, but some consultation obviously took place before that between the banks and the ECB, but clearly the criteria in these provisioning guidelines were largely unanticipated by the banks and the market participants. The granularity of the policy made it very difficult for banks to foresee these specific details. And if anything, we conducted an exercise where we find negative abnormal returns for Spanish bank stocks around the announcement of the ECB policy. So we think that we can claim that this event was largely unanticipated by the markets. The data that we use, as Alejandro mentioned in the previous paper, we use the Spanish credit registry, so extremely detailed data. We look at Spanish non-financial firms. Banks include rural banks as well as EU foreign subsidiaries, although I will show you that in robustness exercises we find that excluding these banks does not affect our main results. We also match the data with quarterly balance sheet data, and later on in the later part of the analysis, we also match this with firm balance sheet information. In terms of the definition of the non-performing loan, it's fairly standard. We follow both the academic literature and the policy documents. By NPL, by non-performing loan, we refer to loans that have been more than 90 days past due. And as a preliminary, graphical evidence, just to show you what happens with respect to the vintage, the evolution of the vintage over time, I'd like to show you a graph where we plot the NPL vintage over time during the sample period. And I think it's evident that the median of the vintage and non-performing loans declines, especially more so in the later part of the sample period, especially following the introduction of the ECB guidelines in 2018 Q1. So, if anything, we have some preliminary evidence that banks actually do get rid of the older non-performing loans, the vintage NPLs. So that is a preliminary analysis. Now, let me move into the empirical specification. So the first question that we ask is whether the vintage of the non-performing loan matters for the probability for the bank to dispose the loan. We're using a model where, and I think this is the appealing characteristic of the data, that the vintage of the loan, we observe it at the loan level. So that allows us to define, if you like, the treatment at the loan level, and that improves our specification in terms of using a number of fixed effects. In terms of definitions, what we have is a dummy for the disposal, whether a bank disposes a non-performing loan in the next quarter or not. We define the vintage as the logarithm of 1 plus the number of months in default. We also define a dummy for the post-policy period. We use a number of loan level controls, and the analysis is conducted on a period 5 quarters before and 5 quarters after, so we use a symmetric window. And we use, as I said, a number of fixed effects, for example, bank time fixed effects, firm time fixed effects, bank firm fixed effects, and more importantly, loan category fixed effects, because we have loans of different types, and that would matter for the probability of disposal. So in this first model, therefore, we are interested in finding what's the effect of the vintage, or put it in a different way, whether banks are more likely to dispose a loan in response to increasing, let's say, vintage by 1%. And then we're looking at the coefficient of beta that would allow us to test out what happens to the probability of disposal for vintage loans in the post-policy period. So the general finding is that banks are more likely to dispose of older loans following the introduction of the policy. If I can give you some numbers just to see what's the economic importance. In our preferred specification, where we use the largest set of fixed effects, a 1% increase in months for a loan categorized as non-performing increases the probability of disposal by about 1.9 percentage points. And when we look at the sum of the coefficients of alpha and beta, as I explained in the specification before, that means that 1% increase in months classified as NPL, that increases the probability of disposal by about 3.3 percentage points. And that would take us to the table, the first table that looks at the probability of disposal. So I refer to column 5, where we have the model that saturates with the greater amount of fixed effects. So that's where we saw that not only larger vintage increase the probability of disposal, but the effect is amplified in the post-policy period. So if anything, our first result is that following the policy, vintage loans are more likely to be disposed by the banks. We try to check the robustness of our findings, and we conduct a number of tests. For example, we dropped the NPLs that had the largest decline, the largest drop over the years. We also drop banks that have low NPLs overall. We also drop banks that have very different business models, for example, rural or foreign banks. And finally, we take into account the possibility that the construction and the real sector, they might have been influenced by the shock in the European debt crisis. And for this reason, we drop these sectors as well. What we find is that our main results hold. We still observe that in the post-policy period, vintage non-performing loans are more likely to be disposed. To reinforce our results, the first set of results anyway, we also attempt to conduct a regression discontinuity design around the policy-induced cutoff points. As you might remember, when the ECB released the guidance, there was, for unsecured loans, there was a cutoff period of 2 years, above which loans would have been fully provisioned. For secured loans, that was starting from 3 up to 7 years. So we take into account these cutoff points, and we run an RTD. What we find, I must admit that this is still in kind of starting stages. We're trying to explore this further, but the evidence that we have so far shows that in the post-policy period, for the induced levels, by the ECB, the disposal is greater, both for secured and for unsecured loans. So this is the summary of for the first set of results. Now, before moving to the second type of analysis, the credit supply analysis, let me just show you whether there are any pre-trends. So what we do, we repeat the analysis before. So we rerun the model that I showed you in the previous slide, but instead we replace the policy dummy with time dummies, and we find that there is no significant change in the disposal of NPLs in the run-up to the introduction of the ECB policy. So that gives us some evidence that there is no evidence of pre-trends in our analysis. I'll skip the results about profitability. Let me go to the second question. So far, we've seen that banks are more likely to dispose non-performing loans after the introduction of the policy. The next question is, okay, so what happens now to the supply of credit? Do banks react, and in what way? To answer this question, we estimate a standard credit supply regression, where on the left-hand side, we have a number of outcomes, actually, not just the supply of credit. We look at new credit, we look at the probability to terminate an existing relationship, we look at the amount of collateral required, etc. But the idea is that we have a model where we interact the policy dummy explained before with a weighted average of the NPL vintage. So this is weighted by the amount of credit, and then a bunch of controls at the firm bank level, plus standard fixed effects that would allow, including firm time fixed effects to control for demand, that would allow us to give a supply-side interpretation. So going to the results, so the second key finding is that banks with higher levels of vintage, they actually reduce lending. Especially, given that we are looking at multiple banking relationships more than other banks. What is the economic interpretation? Well, a 1 standard deviation increase in non-performing loans vintage that roughly corresponds to about which corresponds roughly to about 2 months. That actually reduces credit by 2.7%. By 2.7%. And looking at the table of results, where, as you can see, we saw this reduction in credit. We also find that there is an increased probability to terminate an existing relationship, and we also find that following the policy for banks that have higher levels of vintage, they also ask for greater amount of collateral. So this answers the second question regarding what happens to banks. So far we have seen that banks are more likely to dispose bad loans in the aftermath of the policy. This appears to have an effect on their lending, which we claim it happens through an accounting mechanism, simply because banks have to increase provisions, they take a hit in their profitability, and for this reason they're becoming extra cautious. So if you like, they recalibrate their lending model, and that results in a decline in lending. And once again, looking at pre-trends, we fail to find any evidence of pre-trends in our analysis. So that gives us some comfort and allows us to proceed to the final question. So given that banks are more affected by more exposed, to these policy guidelines, cut credit, what happens to the real economy? Does this shock transmit to companies? So what we do now, we take this analysis at the firm level, so we aggregate it at the firm level. We take the difference between, now this is yearly data, so we take it, the difference between 2017 and 2019. And once again, we compute a weighted average of the non-performing vintage loan at the firm level. And on the left-hand side, we run regressions where we have a number of different firm outcomes, both real effects as well as financial variables. And the dependent variable therefore measures the growth between the end of 2017 and 2019, i.e. before and after the introduction of the policy. And we look at the growth in committed credit, assets, number of employees, tangible fixed assets, and sales. Once again, the main result is that there is a reduction in the growth rate of bank debt for firms that rely more heavily on exposed banks. So this result, if you like, reinforces our previous analysis about credit supply, but we obtain this result now at the firm level. In terms of other real outcomes, we find that a 1 standard deviation increase in non-performing loans decreases the growth rate by 2.3 percentage points, and we also find a reduction in employment growth by about 0.7%. So taking a look at the table where we look at the growth rates between 2017 and 2019, you will notice that we have a reduction in employment, investment, assets, and sale. So if anything, for those companies that rely on banks affected by the shock, their firm level outcomes are negatively affected. And in the last 2 minutes, I will very briefly touch upon the fact that we try to understand whether this effect is the same for all firms, but apparently not firms are affected the same, and we do find that the effect is stronger for the riskier firms. So very briefly, looking at this table of results, you will see that when we interact the vintage with the riskier firms, the result is more pronounced for bank debt, employment, and investment. So not all firms are affected in the same way. Risky firms are affected the most, and this is significant because it's important for policy as well, because these are the firms that they take the most important hit. So let me conclude again by saying that the purpose of this study was to look at the release of the ECB provisioning expectations in 2018. We wish to use it as a quasi-natural experiment and study changes of this policy in terms of the dynamics of the NPL, the bank lending, and the firm dynamics. The evidence that we find is that banks actually dispose of NPLs at a faster rate, but this has a negative effect on their lending, and then this translates into negative firm-level outcomes. There are heterogeneities both at the bank and the firm level, and if there is a policy conclusion that we can draw, we can highlight that banks can be myopic and keep non-performing loans on their balance sheet. But against this backdrop, what we document is that supervisory oversight was very critical for banks to clean and repair their balance sheet. And with this statement, I'd like to close my presentation. So thank you very much, everyone, for your attention.
Thank you very much for the presentation and for being on time. So now we are moving to the discussion of this paper. The discussant is Daniel Paravicini from the London School of Economics.
Great. Well, thanks for having me. It's always a pleasure to come back to this conference. So this changes, right? Okay, cool. The question is, what does regulatory oversight or suggestions on how to provision NPLs, what are the consequences of this in the banking sector? The setting was the announcement by the ECB in 2018. The data is from Spain, and the results are what Serafin said. In terms of the mechanism, I think that the preferred interpretation of mechanism, the paper is somewhat unclear, and this is a great opportunity because this is where I'm going to go at. I'm going to take the results as given. I hear the paper is already R&R, so I'm not going to give any new ideas to referees. I'm just going to talk about the economics. And the way I'm going to tell the story is basically tell the story of a loan that's performing and follow it through all its stages. First, you declare not performing, then you provision it, then you write it off. This is the simplest path. There are many different possible paths. This is the simplest path. And think about this path through the lens of the capital adequacy ratio. So the idea is the idea of looking it through the capital adequacy ratio is precisely to attach a cost to the bank to executing each of these steps. Okay? And I think this serves the purpose of, as academics, we tend to, write regressions and run, estimate regressions where a loan either defaults or doesn't default, and as it matters, there's a lot of nuance on exactly what it means in each of these stages. Just having non-performing versus provision versus writing off. Each of these things have very different implications, so it's going to be useful. And once I tie it to the cost, then we're going to talk about the economics of this. The implications, if you want. And then this will lead to suggestions of what to do with the paper. So I'm going to follow an example loan. Imagine a 10 million euro loan that in the book value of the loan is going to show up as 10. Let's assume it's an ex-ante, super safe loan. You're an IRB bank that just attaches a risk weight of 20% to this. So in the formula, of the capital adequacy ratio, this counts as just, and then in the denominator, it only counts of the $10 million loan, it's only going to add up $2 million, euros, sorry. And I'm going to have a sense of a cost, I'm going to assume a target ratio of 10%, so that then every time there's a change, we transition from performing to non-performing, performing to provisioning. I'm going to ask the question, how much capital would you need to restore the target CAR from, in that change? So that's going to be my measure of the cost. And you can think of that as how much additional capital you need, or if you can't change capital, how much you need to cut lending in order to restore. So that's the flip side. Okay, so that's going to be the story. So from performing to non-performing. So remember that the performing loan has the value in assets is 10, risk weight is 20%, so its contribution to the risk-weighted asset is 2. Suppose that our transitions to non-performing. When does it transition to non-performing? The standard mechanical way is that the loan is 90 days due, late in repayment, overdue. But there's a non-standard way, which banks actually have a lot of control over, which is there's an assessment by the lender that the loan is unlikely to be repaid. So just to say that the transition from performing to non-performing is not just mechanically you are 90 days late. There's a lot of other ways you get there, okay? And there's a lot of discretion on that. So when it's non-performing, I'm going to pick exactly what risk weights you would have when the loan is non-performing. Depends on the regulator, the type of loan, etc. I'm going to pick some numbers here to make the example way extreme. So suppose that in this particular case, the risk weight when the loan is non-performing is 150%. Okay? So that means that the contribution of this loan to the denominator is going to be 15 million euros. So, which means that when you transition from performing to non-performing, the risk-weighted assets go up by $13 million euros. Okay, so in principle, in order to restore your original ratio, you have to increase capital by 1.3 million euros. Okay, now transition from non-performing to provisioning. What provisioning does is basically in the income statement you declare, I'm not going to receive this money. This loan, I'm never going to collect it, so you acknowledge the loss. So in your income statement you say, let's assume in the extreme case that I acknowledge I'm going to receive not a single euro of these 10 million euros. This shows up in the balance sheet in two ways. Obviously on the equity side, you just have the loss of 10 million euros. On the asset side, you don't just cross out the loan, you create a counter asset for minus 10 million euros, so it cancels out the asset side. But the key thing is that when you look at the capital adequacy ratio, two things are happening. First, on the asset side, the risk weight this might sound weird, but even something that you have fully provisioned could still have a risk weight there because they don't want you to have that in your balance sheet. That's bad. So I'm going to just, in this example, I'm going to pick a risk weight of 50%. So this loan, even though it has been fully provisioned, might still show up in the denominator. But the key thing is that your capital dropped by $10 million. Okay? So in order to restore your target capital ratio, in this case, after provisioning, you would have to raise additional $9 million of capital. Okay? So this, you can see clearly that the magnitude of provisioning, the cost, if you measure the cost in terms of regulatory ratios that you have to adhere to, provisioning is way more costly to a bank than just declaring an NPL. Okay? So that's kind of one key thing. The other key thing is that there's a lot of heterogeneity in this because the different banks will have different costs of deviation from the target ratio, different cost of raising equity, different cost of adjusting lending. So all these things are going to determine how, in the cross-section, which banks are more affected by this type of policy. And of course, the loans, the same thing. A safe loan, given that the target, suppose you need to cut lending. If you cut lending on safe lending, you'd have to cut a ton of lending in order to reduce the denominator of that ratio because safe loans are multiplied by a small percentage. Okay, so this channel, if you want, can predict a lot of heterogeneity. Then from provisioning to write-off, this is not that interesting, but in the example I constructed, the bank actually gains. Once you've provisioned the loan, you have lost the advantage of not having recognized the loss of the loan. Actually, in this example I constructed, the bank has a benefit from writing their loan off because you completely wipe out the asset from the denominator of that ratio, and you basically now have a capital credit, if you want. Okay, so in this example, you even it highlights the incentive that banks have when a loan has been provisioned to write the loans off. Sure. What are the implications of this that I think are important for what they're doing? There's two. I'm going to talk just about risk discovery. Banks were living comfortably here, right? You declare loans non-performing, and you don't have to provision them. And this is good from the perspective of capital ratios. This is an advantage. Now, the ECB comes and nudges you towards provisioning, which is going to be very costly for the banks. The key thing is that, what's definitely going to change, that, banks, the incentives of banks to declare a loan non-performing are going to change dramatically, because you're not going to be able to sit in this intermediate comfortable state where it's costless. So what's very likely going to happen is that this is going to change. So the likelihood of banks to declare non-performing loans is going to change. So there's this trade-off between knowing where the risks are and knowing what the risks are and where they reside and how large they are, and be able to force banks to provision accordingly to them. I think this policy has a trade-off. When this policy should, in principle, have a large effect on the likelihood that banks are going to declare non-performing loans. And then this creates two problems for the analysis. The first one is that evergreening, in principle, can cause an NPL to exit the dataset. Suppose that there's a loan that's 90 days late, and I issue another loan, fresh new loan, which used to repay the previous one. I don't have to disgorge a single euro in cash, and suddenly the NPL disappears. In the data, this is going to show up as the loan was disposed of, and that's a problem. Okay, so you might be confusing disposing of loans with evergreening, and that's a problem. And the other thing is that, in the flow analysis, I'm going to finish with I know Serafin is from Greece, so I wanted to finish with a plot from Greece. When you're looking at the stock of these counter assets you're creating, you have two flows. He's looking only at exit, and the discussion here is suggesting that the entry into non-performing is changing. So if you want to analyze changes in the stock of this counter asset, you need to analyze both flows. And that I finish with a picture. This is Greece. Okay, I just happen to have all the balance sheets of the banks in Greece in my laptop. So these are the top four, actually, not five. The top four systemic banks. These are reserves for loan losses. This is basically every time you add this counter asset, you start adding that up. And this is basically, after the financial crisis, the total amount of reserves for loan losses created in the Greek bankings in these four banks. And it's kind of very striking that it goes from 5 billion euros to 47 billion euros and then back. But this hides a lot of action. If you actually look at the changes in the stock and decompose them by entry and exit, this is how the plot looks like. Oh, sorry. This is how the plot looks like. So blue are provisions and impairments. These are the flows into that stock. That is basically your provisioning for loans. As you can see, the pattern is there was low provisioning, then there's 5 years of a very high provisioning, then it drops again. And then on the negative side, in orange, you have write-offs, and in green, you have transfers due to sales, so basically you're securitizing. And you can see that these are different dynamics, and these things are happening at different points in time. And the key thing is, I was missing something like this in your paper. To really understand the dynamics of NPLs, you need to understand the flow in, the flow out. The incentives of both are changing with this policy, and if I had to push you in one direction, it would be in this direction. Just show me the entire dynamics and not just the exit rate. Thank you.
Thank you very much. Now, do you want to answer, or should we proceed to take questions?
We can take questions and I can answer.
Okay. Questions from the floor? Javier, please.
Thank you very much. In some sense, the main outcome that you obtain is expected, no? That by forcing the banks to fully write off previously recognized NPLs, this is going to have a negative impact on those banks' capital and potentially on lending. Is sort of expected, no? But maybe the analysis is not trying, and so I'm suggesting a potential room for expansion of the analysis to identify the potential advantages of this policy, because the way I could read your results is so far so negative, no? Because the new lending by the most affected banks shrinks, and the employment and investment and lending to the most affected firms shrinks. Yes, but of course, why was this policy put in place? Not to produce those effects per se. This policy was put in place under concerns of zombie lending. So maybe actually a positive reading of those effects is that you were killing some zombie lending with the policy. And then you were making banks' balance sheets cleaner, potentially benefiting the industry as a whole. So maybe damaging the most affected banks in terms of having to recognize losses and realize capital losses and lower lending capacity, but maybe the industry as a whole then look cleaner and with the capacity to grow. So I think what is missing then in the analysis also of the real effects is whether there are positive externalities from what you are measuring currently, like bank by bank, when forcing to sell these loans. There could have been a reallocation of lending towards more efficient firms, or there could have been dynamically a better perception about the bank industry, better capacity to get access to the market. So in a sense, I just want to say that the ECB policy was not a crazy policy directed to make the banks suffer just for the sake of it.
Yeah, thank you very much for the presentation. Related to zombie lending again, I thought you mentioned something about the relationships that were broken. You have some results about that. Okay, great. So yeah, I was wondering what those results are in more specific terms. And the second thing I was wondering is whether you have any way to actually measure whether this policy has a persistent impact on the way banks lend to risky firms. What I'm wondering is the following story. So now I know that I have to immediately dispose of a non-performing loan, and hence I try to keep, I do less risk taking than I would otherwise. Yeah.
Okay, so we end with this question.
Simple question, like, I want to understand what's happening on the overall bank portfolio. Like, are these banks downsizing their overall portfolio? Are they rebalancing their portfolio, like related to what happened, also the discussion? Like, are they turning to cash securities, something like that? It will be nice to understand what's happening. Because, like, if we look at the data, these banks were actually increasing the portfolio in this period, the overall assets. So just to have an understanding of that.
So thank you very much. Thank you, Daniel, for the discussion. Thank you very much for the questions. So to answer the question about looking at the entry and exit of loans, yes, that makes sense. We should be able to check that, see what happens, and that would allow us, I think, to disentangle better how the policy works. But, you know, related to Gianmarco's question, I don't have an answer on top of my head. I think we should look into that. I don't know whether banks, you know, change, you know, their portfolio in different ways, but the data are there, so we can definitely look into that. Regarding zombie lending and evergreening, again, this is an issue that we can definitely explore. I don't know. I don't think we have looked at whether banks in any ways extend lending to risky borrowers. But in terms of whether the policy, whether we paint the policy with not so bright colors, the truth is that when we look at the heterogeneity, both at the bank and the firm level, we find that there are differences, and not all banks are affected the same, and not all firms are affected in the same way. So it's not the case that, for example, banks cut credit, you know, across the board. Some firms are more exposed than others. So yes, the effect overall appears to be more negative, if you like, because it affects, you know, lending, but this negative effect is not across the board. And more importantly, let me also emphasize that what we show is a kind of a short-term effect that we are looking at. It could be that potentially in the longer term, this negative effect reverses, and we have, an increase in the supply of lending. This is beyond the scope of the paper, but that could, answer the question that in the longer term, things might be brighter.
Okay, so with this, we close the session. Thank you very much. And we move to the next section directly.
Okay, welcome. Welcome to the last session in terms of panel discussions, of papers discussions of this conference, because after this panel we will have a coffee break, and then there is a panel chaired by Javier Suarez on housing risk and macroprudential policies. So we have two interesting papers to discuss. And since we are just a little bit behind schedule, I'm just going to ask the presenters and the discussant to stick to the time. And with further ado, I'm just going to give the floor to Alex Overgos, okay, more or less, and for the first paper. And it's a pleasure to have you here from the University of Zurich and as a presenter of the paper. And then we have Anatoly Segura from Banco d'Italia as discussant. This first paper is synthetic on how much risk transfer. I think it's a very interesting paper to investigate the dynamics of this market. So without further ado, Alex, the floor is yours. You want this?
Yeah, if I can.
Yeah, give me, okay.
All right. Yeah, thanks so much for having me. So the paper is called Synthetic but How Much Risk Transfer, and it's about the booming market of synthetic risk transfer, also called synthetic securitization. And it's also my job market paper. So the paper is jointly with Glenn Shippens from the ECB, and because we have ECB data, the typical disclaimer applies. Now, before telling you what exactly synthetic risk transfer, or SRT, is, let me motivate by looking at some newspaper articles. Bloomberg writes, if you're unfamiliar with synthetic risk transfers, there's a chance you'll hear all about them when the next financial crisis hits. Matt Levine says banks transfer risk to themselves, and in the Financial Times, the IMF warns of round-tripping fears. And what exactly that is, we will talk about in a minute. Now, these are only a few of the many, many articles written on the topic. In fact, if you look at the news mentions of synthetic risk transfer, they really spike in 2024. Now, what is it? In a nutshell, it's a way for banks to transfer typically the first losses of some loan portfolio to the non-bank financial sector while retaining the loans themselves on their balance sheet. Okay, and they typically do that in order to get capital relief. So let's look at an example. Think of a bank with some loan portfolio. It could be anything, could be mortgages, could be car loans, but because we have fantastic data on corporate loans, why not think about, say, 2 billion euros in corporate loans? And the bank will pool those loans, and they will sell the first losses, in this case, the first 10% of that loan portfolio, to a non-bank investor. And they typically retain the senior tranche. So now the non-bank investor will compensate the bank for all the defaults on those loans up to 10%, and after that, the bank is on the hook. Now, very importantly, the loans themselves don't actually leave the balance sheet. Okay, and so for taking on that risk, the non-bank investor is being compensated with regular fee payments above some spread. And the objective really here is to get capital relief. So the market of SRT is big, and it's growing super fast. So here we plot the stock of SRTs in Europe in the space of corporate loans alone, where we have data, and you see that it grew from 2018 to 24 from 60 billion euros to now 300 billion euros. And it's also big in relative terms, so most of the big banks have at least 10% of their corporate loan portfolio synthetically transferred to non-banks. In the US, the market is a lot smaller, but growing even faster at 400% in 2024. And so we investigate this market in Europe, and I think in this mature SRT market, and I think we anticipate some of the developments that we will see in the US in terms of SRTs. Now, what do? We want to characterize the market and along the way highlight potential risks to financial stability. So the first potential risk might come from the selection of SRT loans, so the loans that are synthetically transferred. The second one from the monitoring of the firms whose loans are transferred, and the third one from the interconnectedness of the banks with the non-bank SRT investor. So I told you that the objective of doing SRTs is to get capital relief. So a natural way to start this investigation is to ask, how does the objective of receiving capital relief inform the decision of which loans to select for the SRT? And we find that all else equal, banks choose capital expensive loans. And as the banks redeploy the freed up capital, they actually become effectively less capitalized relative to the economic riskiness of the loan portfolio. And I'm going to elaborate and give you a detailed example of how that argument works in the first part of the presentation. Then we develop a novel measure of monitoring, actually somewhat inspired, apparently, somebody must have leaked that to Gianmarco. We're going to look at the PD updates for monitoring. And then we find that banks reduce the monitoring relative to other banks that lend to the same firm. So we control for the endogenous match between banks and firms. And then finally, on the interconnectedness of banks with a non-bank SRT investor, this is what the media was most worried about. And here we find that banks are more likely to sell SRTs to SRT investors to which they also grant credit. So there seems to be a familiarity between the two players. And then our results suggest that on average 26% of the SRT investment is funded by banks in the form of credit to these non-bank SRT investors. And this is what the media referred to as round-tripping, where some of the money comes from the banking sector and is then invested into the credit risk of the banking sector. I want to stress that it's not necessarily the SRT issuing bank that provides the credit, it's rather the banking sector as a whole. So in the remainder of the talk, I want to briefly touch on the contribution to the literature, then talk about the data. We have loan and investment level data, and then go through these three potential risks to financial stability. So on the contribution, let me be brief here. So we join these two strands of literature, one on the capital optimization and the other one on credit risk transfers and financial stability. And we show that if the objective to do credit risk transfers is to receive capital relief, then that might have implications for financial stability, as I'm going to show you in a minute. And then we contribute to the literature on credit risk transfers and moral hazard by this new monitoring measure. And finally, there's an emerging literature on bank, non-bank interconnectedness, where we contribute with loan and investment level evidence, which is, I think, extremely detailed for this type of literature. Now on the data. What I want to do is show you the ideal data set that we obviously don't have, and then show you what we actually have and how close we get to that. So in order to understand the loan selection and really characterize the SRT market, we want to have the entire loan portfolio of the bank. We want to know each counterparty. We want to know at which time which loan is synthetically transferred. We also want to know which transaction it is part of, so which loan pool each loan is part of. We want to know how much of the risk is being transferred to non-bank SRT investors. Ideally, we want to know the fees. Then it would be nice to know who the non-bank SRT investor is. And in order to understand the interconnectedness through credit with the banking sector, we want to know the loan liability. Now here's what we have. So using AnaCredit, we have the entire corporate loan portfolio of the bank. So no mortgages, but much of the SRT is happening in the corporate loan space anyways. So we get a good coverage here. Then we know each counterparty involved. AnaCredit comes at a monthly frequency. We know exactly which loan in which month is synthetically transferred, which loan pool, so which SRT transaction it is part of. We also know how much of the risk is being transferred, so the tranching of this SRT, we don't have the fees. Then for most of these SRTs, we also have the SRT investor, and because AnaCredit also includes loans not only to non-financial firms, but also to financials, we also have the loan liability structure. Importantly, roughly 1/3 of investors are US-based, so we don't know their funding structure to the extent that they fund themselves in the US. Now, this gives us a sample period so AnaCredit, as many of you here know, starts in September 2018 at a monthly frequency until currently. And then we have 70 banks that use the SRT. Let me just briefly say, who are these SRT banks, the banks that use the SRTs? It's a typical, sick patient getting the medicine kind of story where, they're the ones with the low tier 1 capital ratios and the risky loan portfolios. And generally, the bigger banks, right? You need access to this technology. And then we have 350 SRTs, 170,000 SRT loans. And let me again stop here and tell you a bit about the SRT loans. So one remarkable feature when you compare it to traditional securitization is that now you're going to have a lot of credit lines in there in these SRT loans, because you can actually, the loans themselves don't actually leave the balance sheet, and for credit lines you need an owner with a credit, like a liquidity facility, right? Which typically banks have, and many of the investors do not. Then we're going to have, this has a notional value of 260 billion euros. We're going to have 90 non-bank investors, of which we can identify 65 as the ultimate investor. Sometimes there's a special purpose vehicle in between, in which case we cannot do that. Okay, so now let me talk about the loan selection. And what I'm going to try to argue is that through a strategic loan selection that really has this capital optimization in mind, the bank is going to be effectively less capitalized after the SRT compared to before. And here's the argument. So imagine a bank with just 2 loans, both 100 euros. And they have a true probability of default of 1%. So that's their economic riskiness. And now ideally, like the bank, when granting loans, they have to hold capital against those loans. And ideally, from a financial stability perspective, it would be nice if the economic riskiness, so the true probability of default, is somewhat reflected in how much capital they have to retain, right? So in other words, like the economic riskiness should be equal to the assigned riskiness through those risk weights. In reality, it might be, there are many reasons to think that that's not the case, and we're going to have capital cheap loans and capital expensive loans. So the left-hand side is now capital cheap, that's what the bank likes. The right-hand side loan is capital expensive, it's what the bank doesn't like. And reasons for that might be that the bank uses a standardized approach, in which case the risk weights are coarse buckets. And the second one might be that, and there's a lot of literature on this, that the bank strategically underestimates the probability of default. And then finally, and this is what we're going to use for identification, is there's regulatory intervention that drive a wedge between the assigned and the economic riskiness. So then further assume that this bank has a Tier 1 capital ratio of 10%, and like now the unweighted regulatory leverage ratio of 5%. And now the bank does the SRT. Our hypothesis is that they're going to synthetically transfer the capital expensive loan, right? That's their objective is really capital optimization, so they're going to get rid of the loan that they don't like, namely the right-hand side loan. And then they temporarily have a higher Tier 1 capital ratio and the same leverage ratio. Now, it doesn't stop here, right? Because banks typically have like a target Tier 1 capital ratio, and they're going to redeploy the freed up capital. So they're going to do more lending, which is great for the real economy, but they're also going to now be able, because they freed up the capital expensive loan, they're going to be able to make more of the same lending, namely 150 euros in the same loan. And through that, they're going to have the same Tier 1 capital ratio and now a lower leverage ratio. And what I'm going to do now is I'm going to first show you the first part, so that the banks synthetically transfer the capital expensive loans, and then I'm going to show you the second part, namely that they encumber the freed up capital. So it's kind of difficult to know, to know the real wedge between the assigned and the economic riskiness, because that's super endogenous to the loan characteristics. So what we do is we use a discontinuity in the risk weights such that like the assigned riskiness of a loan increases without affecting the economic riskiness. And we do that in the form of the SME supporting factor. But I want to stress that like now this is kind of like a laboratory, but in real life there's many reasons why we believe that there's a wedge between the economic and the assigned riskiness, right? So the SME supporting factor should incentivize banks to lend to smaller firms by making the risk weights an increasing function in the firm size. So here we plot the risk weights on the y-axis and the firm revenue on the x-axis, and you can see that the risk weights are increasing in the firm revenue, and then discontinuously so at a firm revenue of 50 million euros. And importantly, the size of the jump depends on the bank firm exposure. So for low bank firm exposures, you're going to have a higher big discontinuity, whereas for higher bank firm exposures, you're going to have a lower discontinuity. And we're going to exploit exactly that. So to show that, and now basically what we want to do now is we want to show that this risk, like this discontinuous increase in the risk weight, is matched by an increase in the probability of synthetically transferring a loan around that threshold. So we run this regression of the SRT loan dummy in a given year on these borrower revenue bins around the 50 million threshold, and for two different samples. One is where there's a low bank firm exposures below 15 million euros, where there actually is a discontinuous increase in the risk weights, and the other one is for small bank firm for high bank firm exposures where there's no discontinuity in the risk weights. And what you see is really like this increase around the threshold where we expected, right? Where there is an increase in the capital expense of the loan, we see a higher likelihood of synthetically transferring that loan. And we have a bunch of robustness checks, and we also show that it seems to matter for this SME supporting factor also seems to matter for many firms, not just around the threshold. So now we want to show that the capital is being encumbered. So it's being redeployed, the freed up capital. And the way we do that is we run some bank characteristics, like bank level variables on SRT intensity as just a measure of how much SRT the bank is doing. So, and in the first two columns, you see loan growth in a given quarter, and you find that a 1 standard deviation increase in the SRT intensity is associated with a 9% increase in the loan growth in a given quarter. And as you can see in column 2, it also feeds into the other quarter. Exactly. So now on the leverage ratio, thank you. On the leverage ratio, this is also what we predicted. There's going to be they're going to lever up, so the regulatory leverage ratio is going to decrease in the year with a higher SRT intensity, and in line with some target Tier 1 capital ratio, there's going to be no effect on the Tier 1 capital ratio. And okay, so that concludes the first part, and then and now we want to show that as banks, basically, as the credit risk is borne now by this SRT investor as opposed to the bank, they might, we want to show evidence in line with them maybe not caring so much, right? And maybe stopping the monitoring process. So what we do, and this is why I said it's in line with what Gianmarco earlier said, we assume, make the assumption, and I think it's a reasonable assumption, that the true probabilities of default fluctuate over time, right? Some stochastic process. And the bank, through monitoring, they want to map those PD fluctuations into their own estimates. And we assume that banks that monitor are better able to do that and more timely update their PD estimates in line with the actual fluctuations. Whereas banks that do not monitor so much will less frequently update their probability of default. So remember that our data was monthly. Now we're going to collapse it to the quarterly level, and we're going to have two measures of monitoring. The first one is whether or not there's a PD update in a given quarter by a given bank, and the other one is the standard deviation of the probability of default estimate. Now, this is also in line with many papers that show that as you have a more precise estimate of the probability of default, you're also going to have a higher variance of that probability of default estimate, and this is captured by the standard deviation of the probability of default estimate in a given quarter. We also validate that and show that banks that update their probability of default estimate are actually better able, like it contains more information, as in it's more positively associated with actual default 1 year down the line than banks that do not update their probability of default estimate. And so we run these monitoring measures on basically like a SRT loan dummy and a post-SRT loan dummy, just interacted them. And of course, we're worried that there's many things happening at the firm level and the bank level that are independent of monitoring. So to alleviate that concern, we're going to, in column 2 and 4, use firm times quarter and bank fixed effects. And we show in this table that according to these measures, there's so an SRT is associated with a decline in the monitoring of 15 to 30%. Now, finally, on the bank non-bank nexus, so this interconnectedness, and remember, this is what the media was most worried about. So Reuters says banks' hot new trade could burn others for once. Matt Levine really disagrees and says banks transfer risk to themselves. And the IMF sides with Matt Levine on this and warns of round-tripping fears. So what we do first is we're going to show that there's a familiarity between the SRT bank and the investor by showing that it's more likely for there to be a credit relationship. Having a credit relationship has a positive association with there being an SRT investment. So we run this regression of SRT investment dummy on whether or not there's a credit relationship and granular fixed effects. I should have said earlier, so the investors in this transaction are typically like hedge funds, insurance companies, and pension funds, but also the European Investment Fund, which is run by the European Investment Bank. So we exclude this from this regression because I guess that's a bit of a special case. And so we show across the table that having a credit relationship, whether it's the investor group or the unconsolidated investor, is really associated with a higher probability of investing in a given SRT. So there seems to be this familiarity. But so what the media really wanted to know, I guess, is if some of the money is borrowed that is invested. So which might indicate that the banks are actually on the hook if a super adverse shock were to happen. So we don't really know if, like in unaccredited, you have super detailed data, but it doesn't say like this loan is being used to invest in an SRT, right? So we kind of need to tease out if there is a connection between the actual SRT investment and and banks granting loans to the SRT investor. Right? Obviously, many of these SRT investors, they're going to have credit, right? But is there going to be a connection between that credit and the actual SRT investment? And the way we try to do that is by running the log debt amount outstanding of an investor on the month to SRT investment. And it's just like an event study, including the SRT investment, like an SRT dummy, SRT fixed effect, as well as a calendar time fixed effect. And we don't really know when exactly they would have to commit the money, but so for now we choose 6 months before the SRT investment. And what you see is that it goes up a little bit, the log debt amount outstanding, but not a lot. But now you have to know that not all of the SRTs are actually funded, meaning cash collateralized. So for many of the investments, so some of the investors, such as the European Investment Fund, for example, they don't even need to commit money, so they wouldn't have to borrow any money either. So now we're only going to look at funded SRTs, where the non-bank SRT investor actually needs money. And there you have this increase in the run-up to the SRT investor, in line with some of the money actually coming from the banking sector. And then just to show that like this, there is, just to like make the connection more explicit, we're going to also make the connection between the debt outstanding as well as the SRT size. So we would expect more lending for a bigger SRT. And here we show that funded and large SRTs are associated with a bigger increase in the log amount outstanding of these SRT investors in the run-up to the SRTs, to the SRT investment. So to the extent that this actually captures money that is then being used to the SRT investor, like this dynamic, we like a back-of-the-envelope calculation shows that, so on average, 26% of the funding comes from the banking sector in the form of credit. 1 minute. Very good. Very good. So, so basically, so let me conclude. It's a bit of an extended conclusion, so I'm going to need that minute. So we show that when the objective of risk transfers is really to get capital relief, then the loan selection is going to optimize the effective ex-post capitalization of the bank. In other words, they're going to be riskier relative to the assigned riskiness. And we also quantify this and show that it's associated with a capital savings of 315 million euros for the average bank. And we also, so now many of you know that there's going to be introduced a floor on the risk weights relative to the standardized approach, and we hypothesize that might be traded away through SRTs that are super flexible. Then we show this decline in monitoring, and we show that some of the money might come from the banking sector. We also have a result that this might be higher in the US because there are some tranching differences that are going to, in essence, basically the junior tranche is thicker in the US, which lowers the returns. One way to increase the returns is to actually have more leverage in the system. And we actually find that in our European data that the thicker the junior tranche, the more leveraged the investor. And this might imply that US investors are going to be more leveraged. Now, this also might mean that SRTs are pro-cyclical. And finally, I want to conclude with saying that the amount of capital relief for SRTs should account for these three channels.
Thank you very much, and thank you for sticking to the time. So I'm going to give the floor to Anatoly. I'm going to give me this. Thank you.
So, thanks for inviting me to discuss this paper. It's great to be in this conference, and of course the usual disclaimer also applies for me. So the paper touches upon a market that is gaining a lot of attention among investors and also policymakers. It is growing a lot in the European Union, in particular also due to some regulatory interventions. And this is the first paper, first academic paper that contributes to the potential financial stability implications of the development of this market. The authors find that synthetic securitization leads to an increase in leverage and lending, a reduction in monitoring of the transfers loans, and also to an increase in interconnection between banks and non-banks. So in my discussion, I will describe a bit more the market and the regulatory environment, and I will make some comments on the main results and also on their interpretation. So let us start with the traditional securitization that we know better. So the bank has originated some loans, and it puts them together. It tranches the cash flows of these loans and assigns losses to different tranches. So there is a first loss or junior tranche that is going to be assigned the first losses, and that the bank, mainly for incentive purposes, will keep as skin in the game. In traditional securitization, the mezzanine and the senior tranches are sold off to outside investors. So in the end, the bank is only putting capital for the junior tranche that is very small, even though it has a high risk weight. So the bank is saving on capital. Now, with synthetic securitization, everything is done on balance sheet. So the bank has that pool of loans, and it tranches the cash flows and assigns losses to the different tranches. And the bank keeps all those tranches on balance sheet. But what it does is that it buys protection, insurance, for the mezzanine tranche. So there are some insurance providers that are going to insure the potential losses of that mezzanine tranche. So everything is held on balance sheet, but since the mezzanine tranche is relatively high in size and has a high risk weight, by buying insurance on that mezzanine tranche, the bank is able to get zero risk weight on that asset that is held on balance sheet and achieves some significant capital relief. So this is why banks like this type of synthetic securitization. Now, if you compare synthetic securitization with the traditional securitization, then there is directly more risk that is held on the balance sheet of the banks, because that is the senior tranche. Now, there is a positive risk weight that is, so the bank has to put some capital for that senior tranche that is held on balance sheet, but the risk weight could increase as losses materialize. That could introduce procyclicality, and also those senior tranches can be, they're complex assets and they can become opaque upon bad shocks, and that could introduce some funding problems for the banks in crisis. And now there is the mezzanine tranche that is held also on balance sheet, and the bank is exposed to counterparty risk. So the risk that the insurer might not be able to satisfy the insurance, especially during crisis. Now, this is mitigated if the insurer provides high quality collateral. And in particular, a requirement to benefit from a zero risk weight on the mezzanine tranche is that the insurer fully collateralizes with high quality assets that investment. Now, there could be some indirect effects that are differential between synthetic and traditional securitization that mitigate or exacerbate financial stability risks. These are related to how then with how securitization, the two types of securitization differently affect lending and risk-taking, screening, monitoring, and the interconnection with non-banks, explicit or implicit. So, as a general comment, so this type of paper or our analysis of the market can have two objectives, and one is to highlight the similarities between the two types of securitization. That is interesting, and much of the results of the paper hint to the fact that synthetic securitization is similar to traditional securitization. And I think it is important, it would be very interesting to understand what are the key differences and the potential new risks that this type of securitization could give rise to. Now, the market is booming in the European Union, and this also because of some regulatory interventions in 2021 that allowed to banks to get additional capital relief when they do synthetic securitization. So this is part of why the market is booming. So, my comment. So the first finding is that synthetic securitization is associated with more leverage and a lending expansion. So I think this is an intended effect of the policies that support synthetic securitization generally, and in particular synthetic securitization. And this is consistent with the evidence that we have on traditional securitization that supports lending. So I think what it would be interesting to know is whether this synthetic securitization expands lending more or less than the traditional securitization. So I wonder if it would be possible to try to come up with some sort of capital relief lending multiplier estimate across the two types of securitization types. So for each euro that gets capital relief through securitization, how much is lent out to the real economy, and whether or not synthetic securitization has a lower capital relief lending multiplier. That is what one would expect, because the bank is anyway holding the aggregate risk that is retained in the senior tranche. So one would expect the the capital that is relieved out of the insurance of the mezzanine tranche to be less used to lending than through traditional securitization. Then let me skip this comment that was too technical. Then there are some results in the paper that point to the fact that the synthetic securitization is allowing banks to excessively exploit the SME supporting factor, so the capital discount that banks can benefit from lending to small and medium enterprises in the European Union. This mainly because part of the capital relief from securitization is used to lend to small and medium enterprises that benefit from that capital supporting factor. The paper comes up with an estimate of 7 billion euros that I think is far too large, and just I did the back of the envelope estimation to get like a stupid upper bound on that additional exploit, and still I got something below 7 billion euros. So imagine all the stock of synthetic securitization outstanding out there in 2023 were benefiting from, were in the form of lending to big firms that don't benefit from that capital supporting factor and had a 100% risk weight, maximum risk weight, and all that capital relief was used to lend to small enterprises, small firms benefiting from the larger capital discount, which is of 24%. If you do that estimation, like very stupid, you get 5 billion euros is below the one you get in the paper. So I think it's a bit of overstated. This idea that synthetic securitization is kind of leading banks to excessively exploit the capital, I mean the incentives to support lending to small enterprises in the capital regulation in the European Union. Then, when it comes to the results on how synthetic securitization affects incentives to monitor, the paper uses a novel proxy for monitoring coming from the PD update frequency, and the paper finds that that frequency falls for loans that have been synthetically securitized. So I think that, I mean, there could be some issue with the interpretation, because one might think that the investors could be picking the best loans that banks have, and that's the reason why we don't see PD updating is because these loans are good or relatively better than those that are held on the balance sheet, and simply there is no updating because the quality of those loans is not worsening. So I think that the finding could be supplemented with analysis of realized defaults, also to understand whether or not the banks are selling the riskier loans to outside investors or not. And something that could be also interesting to look at is because in this market, as Alex said, there is a sort of the Fannie Mae or Freddie Mac, which is the public agents, especially the European Investment Fund. So it would be interesting to analyze whether or not the private investors put more discipline in the market and mitigate those concerns of weakening of monitoring incentives or not. And then when getting to the last result, which is the one that was motivated in the first slides of the presentation, the issue of the round tripping, meaning that it is the banking sector that at least partially is funding the insurance that is provided to the mezzanine tranches that are synthetically securitized. Of course, that would be a concern. I think, I mean, the paper finds that ahead of the investment in this in the insurance of these mezzanine tranches, investors get more bank funding. But I think, to the very least, the author should try to control for the growth of other assets in the balance sheet of those investors, because otherwise they are attributing all the bank funding to investment in these products, while they could be simply expanding their overall balance sheet. So to conclude, very interesting paper, first academic contribution to a market which is gaining importance. The evidence is kind of saying synthetic securitization is doing something very similar in terms of its effects to traditional securitization. I think we should understand better what dimensions make synthetic securitization special from a financial stability perspective. Also, from a policy perspective, to understand whether or not we should keep on supporting through policy measures the development of this market. So looking forward to the next version.
Thank you both of you. Alex, would you like to react, to comment?
Yes. So thanks so much for the very good discussion. I had the benefit of knowing some of the comments beforehand, so I'm not going to reply to all of them, but they're all very well taken. So let me just say, on the PD updating quality, it's just the average loan. In terms of PD, it's not necessarily the super risky stuff or the super risk-less stuff. It's rather just the average loan. And then so on the PD updating, like we identify that through basically the change in the probability updating from before to after the SRT. But I definitely want to do more work, and I think you hinted at the right direction here. I'm happy to speak privately. Thanks so much.
Perfect, thank you. Okay, yes, I see one hand over there and another one on the other side.
Hi, so super interesting evidence, like a lot that's in a very nice, with a very nice identification. We're able to see the consequence of securitization for risk taking and monitoring. Now we'd like to bring a little bit like a more positive view to this type of contracting that is introduced. So because I think this could be great, right? So in a way, we're taking our risk from the banks. So that's maybe what the regulators want. If you think that this is funded by, I don't know, other outside investors, you can think of it as outside equity, which is increasing and giving loss absorption capacity to the system. So it can be great. Now you say it generates more risk, but that is going to be accounted by the investor, right? So they're going to know about this, so it's going to be priced, and this can be welfare enhancing. Now you say part of that risk stays at the banking sector, so that generates interconnectedness, and that can be bad. But we also could think that, I mean, this is generating like a mutual risk-sharing mechanism across banks. So if you think that there is only idiosyncratic risk, this could be great, right? You are making the banking system actually safer for all of the banks. If we add aggregate risk, then things become a little bit more complicated. So I think in that direction, I think maybe we would need some theoretical frameworks to help us to think about these issues. And this combination between diversification of risk and generating moral hazard. And so Anatoly has been a little bit shy on citing our work, but we have a theoretical paper actually that goes in that direction. So, but super interesting.
Thank you very much. Let's hear the other question first, and then I give you the floor to you, Alex.
Very fascinating. So I was really wondering what's going on when they actually finance the SRT, in the sense that you take risk weights off so you free capital by insuring this tranche, but at the same time you're giving out a loan, right? So that will have a risk weight. And so I'm wondering, is it some shortcoming of regulation that actually is not compounding this effect, or something else? Where I'm leading to is maybe it's not actually financing, maybe it's a previous relationship that these two entities have, and now there is this one more business opportunity between the two.
Okay.
Yeah.
Yeah, Alex, go ahead.
So thanks a lot for the comments. Great comments, especially, I mean, the idiosyncratic versus aggregate risk is, I got to read up on that. Yes, so one thing, so the positives, I mean, especially on the last point, so this is what the media has been most worried about, right? I didn't have time now, so I basically, what I did is just document this interconnectedness. I think, so this debt is still senior, et cetera, so the adverse shock, and it's only one loan that is granted by the bank to this non-bank SRT investor. So I feel like I wouldn't cry wolf just yet, right, on this interconnectedness, just because of the seniority of debt vis-a-vis equity and so on, like the adverse shock must be extremely big in order to for this to pose a risk to financial stability. And then so the risk weight of the loan would just be the risk weight that any loan to a financial company has, right? So, but that's one thing I want to do in the future is kind of calculate like how much capital is saved vis-a-vis how much this loan costs in terms of capital, right? To get at a bit of an aggregate figure. Very good comments. I'm happy to discuss more later. Thank you.
Thank you very much. Very interesting paper. Thank you, both of you. So we go to the second part of the session. We have Tanja Breeden from Vienna Graduate School of Economics presenting the paper Anything But Equity on Banks' Preference for Hybrid Debt. And then we will have Salem Bahajis, University College of London, as discussant. Yes. Give me a second. We just grab this. Please just stay, standard timing, 25 minutes, 10, and then 5 minutes.
Okay, thank you. So I'm excited to share today the findings of my work called Anything But Equity on Banks' Preference for Hybrid Debt. I'm a PhD student at the Vienna Graduate School of Finance. I'm going to be on the job market in the fall, and I would like to thank the organizers for including the paper in the program. So, the latest global financial crisis has shown that failures in the banking system can lead to long-lasting economic damage, and that's why we cannot let banks fail as easily as normal firms. But on the other hand, we do not want to bail out banks, meaning rescuing them with taxpayers' money. So Basel III suggested the introduction of bail-in tools as part of Tier 1 capital that should absorb losses before banks default. And in the European Economic Area, the area that I'm studying in this paper, those bail-in tools come in the form of contingent convertible bonds, or short CoCos. And those CoCos are hybrid debt instruments. They are first debt, but then absorb losses if a pre-specified trigger is hit. Usually those instruments require lower returns than equity, but often fail to absorb losses before a bank's default. And in the EEA area, those CoCos never absorb losses before a bank's default. And given that this bail-in function is quite uncertain, the central question of the study is who are the issuers of those CoCos and what are the possible incentives behind issuance. And to address this question, it's important to understand how CoCos function in the context of capital regulation. And I'm going to start with a bank's regulatory balance sheet. So on the asset side, the bank has various assets, and every asset is given a rate reflecting the riskiness of the asset, and the sum of those rated assets then make up the risk-rated assets. On the liability side, the bank has common equity Tier 1 capital that you can think of as equity, and it might have additional Tier 1 capital that is not equity, but is supposed to be going concern capital and absorb losses before banks default. And then the bank has other capital that is not in the focus of the study, and it's gone concern capital, so should not absorb losses before banks default. And the sum of the CET1 capital and the additional Tier 1 capital is the Tier 1 capital, so the bank's going concern capital. So banks have to fulfill Basel III capital requirements. The CET1 ratio, so the ratio of CET1 capital to risk-weighted assets, has to be always above 4.5%, and the Tier 1 ratio has to be above 6%, and if the bank reports either of the two ratio, a ratio below these capital requirements, or either the CET1 ratio or the Tier 1 ratio, the bank is considered bankrupt and will be resolved. So now let's assume that a bank has additional Tier 1 capital in the capital structure in the form of contingent convertible bonds. And those CoCos absorb losses before default if a pre-specified trigger is hit, which is defined as the ratio of CET1 capital to risk-weighted assets, and the minimum trigger level for Tier 1 eligibility is 5.125%. So if the CET1 capital, the reported CET1 capital is sufficiently small and falls below the CoCo trigger level, those CoCos are designed to automatically absorb losses. They disappear from the bank's regulatory balance sheet, and the CET1 capital is automatically improved. The question is now how banks in the European Economic Area fulfill Tier 1 capital requirements. So we have 35% of banks that have minimum trigger CoCos outstanding, and those CoCos are equipped with the minimum trigger level of 5.125%. So the CET1 capital ratio would need to fall below 5.125% before those instruments absorb losses. Then we have 15% of banks that have CoCos with higher trigger levels. Usually those trigger levels are 7%, but they also, in some cases, are 9%. And then we have 55% of banks that have no CoCos in their capital structure. And conditional on instrument, CoCos amount to about 10% of Tier 1 capital. So if banks issue CoCos, they issue quite a lot of them. And the question is, who are the issuers and non-issuers of CoCos in the context of regulation and Tier 1 capital? Well, from the CoCo literature, it's usually stated that relatively better capitalized banks issue CoCos, and those studies usually do not focus on regulatory Tier 1 capital, and also have CoCos in the study that count towards other capital and are gone concern instruments. But from the regulatory arbitrage literature in general, we know that banks unconstrained by capital requirements have no incentive to issue Tier 1 hybrid debt. So the key is really to distinguish between the trigger levels of CoCos, and this is the first paper that does so, and distinguishing between minimum trigger and higher trigger CoCos, I find that the less capitalized banks are more likely to issue minimum trigger CoCos, whereas higher trigger CoCo issuers are better capitalized than other banks. And this better capitalization actually occurs through those CoCo issuances. I also find that less capitalized banks issue minimum trigger CoCos sooner, and by studying reactions of market participants, I showed that higher trigger CoCos, a certain subset of higher trigger CoCos can lower a bank's probability of default, but minimum trigger CoCos are considered gone concern instruments by market participants. A quick look into the data. I cover 155 banks in the European Economic Area on the fully consolidated level. And I have data from 2006 to 2022. Most of the empirical analysis starts in 2010, though. I have 69 CoCo issuers covering 90% of CoCo volumes, and the remaining 10% of the CoCo volumes are issued by banks that are not in this data set. The CoCo data is from Bloomberg, and the bank balance sheet data is from Orbis, and then I matched the CoCo data with the bank balance sheet data by hand. And that's important because bank's balance sheet data does not report the volume of CoCos in a bank's capital structure. And by matching CoCo issuances and also CoCo calls, because these instruments can be called after 5 years, I can compute the volume of CoCos outstanding in a bank's capital structure, and I can compute an adjusted Tier 1 capital ratio, excluding those CoCo volumes from the calculation of Tier 1 capital. So the ratio is defined as Tier 1 capital minus those CoCo volumes divided by risk-weighted assets. I have systemic risk measure data from Gehrig and Iannino, and my CDS data is from Market. So you might think that only large banks issue CoCos in the first place, and table 1 shows you the size of asset values in US dollar billions for the different issuer types. So it's true that higher trigger issuers in both and issuers of both types of CoCos are generally larger, but 20% of those banks still have asset values below 50 billion. The median non-issuer of CoCos is of the same size as the 4th decile minimum trigger issuers. So it's not true that only big banks issue CoCos. And then what is interesting is to look into the aggregate net issuances of shares, net of dividends, and CoCos. I realized that the figure 1 lacks the x-axis, but the data starts in 2010 and ends in 2022. And I plot those issuances for both CoCo issuers and non-issuers separately, so you cannot really compare the aggregate issuers across the groups, but within groups there are some interesting observations. So net issuances of shares and CoCos have been positive for CoCo issuers until 2014, and afterwards net issuances of CoCos have been positive until the very last year of the data set, but the net issuances of shares became negative, and the relative net issuances of shares after 2014 in sum has been larger than the previous positive net issuances of shares. For non-issuers, you can also see that net issuances of shares become negative in 2016, but the aggregate negative net issuances from 2016 on are in sum not as big as the previous positive net issuances. And then I also want to show you a time series plot of Tier 1 capital ratios of minimum trigger issuers and non-issuers, and then in the next slide of higher trigger issuers and non-issuers. So if we plot Tier 1 capital ratios over time, the green line is the Tier 1 capital ratio of non-issuers, and the purple line is the Tier 1 capital ratio of issuers of minimum trigger CoCo, so CoCo is equipped with the minimum trigger level, and then the slightly reddish pink line is the adjusted Tier 1 capital ratio, as if CoCos did not count towards the calculation of Tier 1 capital. You can see that that Tier 1 capital ratios overall went up, and interestingly, the Tier 1 capital ratios of minimum trigger CoCo issuers align with the Tier 1 capital ratios of non-issuers, but if you exclude the CoCo issuance volumes, you can see that the adjusted Tier 1 capital ratio is much lower. And for higher trigger issuers, you can see that now the purple line again is the Tier 1 capital ratio, but now for higher trigger issuers, the Tier 1 capital ratio is slightly above the Tier 1 capital ratio of non-issuers, but the adjusted Tier 1 capital ratio is not higher than the ratio for the non-issuers of CoCos. But of course we can also test this formally by analyzing the volumes of CoCos relative to Tier 1 capital in a bank, and the determinants that explain the CoCo to Tier 1 capital ratio. And for that, I regressed CoCo to Tier 1 capital ratio on a bank's adjusted Tier 1 ratio and several other variables that I can better explain in the next slide. But the topic regression limits this ratio to 0, so the CoCo to Tier 1 capital ratio can of course not be below 0. And here are the results of the ratio of minimum trigger CoCo volumes relative to Tier 1 ratio, Tier 1 capital. And the first two columns only control for asset size. And then in the first column, so in the odd columns, I always regress the adjusted Tier 1 capital ratio on the volume of CoCos outstanding in a bank relative to Tier 1 capital. And in the even columns, I regress the Tier 1 capital ratio. And then in the third and the fourth column, I analyze other variables that might explain a bank's decision to issue CoCos, and in the last two columns, I include bank fixed effects. So what we can see is that issuers of minimum trigger CoCos have significantly lower adjusted Tier 1 capital ratios. So excluding bank fixed effects, 1% lower adjusted Tier 1 capital ratio is associated with a higher volume of minimum trigger CoCos relative to Tier 1 capital of 2.26%. So this regression is in absolute levels. What is also interesting, you can see in the third and fourth column, is that those issuers are systemically riskier, so they are more likely to suffer losses in adverse market conditions. Also interestingly, the effective tax rate seems not to explain CoCo issuances a lot. CoCo coupons are tax deductible, so one incentive for issuers could be to have the tax advantage of that over equity, but the effective tax rate seems not to explain issuance decisions. And CoCo issuers in general are larger banks. And now let's look at the higher trigger CoCo issuers. And also here I regress the higher trigger CoCo relative to Tier 1 capital volumes in the first two columns only on the adjusted or Tier 1 capital ratio and on bank size, and then have more variables of interest in the other regressions. What you can see here is that the adjusted Tier 1 capital ratio, so excluding those CoCo issuances from the calculation of Tier 1 capital, are not lower than other banks. So those issuers have, even without those CoCo volumes in the capital structure, have equivalent capitalization relative to other banks. But through those issuances, if you look at the Tier 1 capital ratio, the banks actually improve their Tier 1 capitalization above those of the other banks. What is interesting is that higher trigger CoCo issuers seem to have a higher fraction of impaired loans in their capital structure, which might be associated with those banks wanting to have a buffer against losses resulting from those impaired loans, and those issuers are also, in general, larger banks. And then I also run a duration analysis to look into the determinants of first-time CoCo issuances. For the interest of time, I'm just gonna show you this like one slide without the regression tables. The duration analysis is conducted both for testing whether non-issuers are unlikely to become issuers in the future and also to rule out mechanical effects. So what I find is that less capitalized banks issue minimum trigger CoCo sooner, so the non-issuers of CoCos are unlikely to become issuers of minimum trigger CoCos in the future. Less profitable banks and those with more impaired loans issue higher trigger CoCos sooner. Less profitable banks might issue higher trigger CoCos sooner because they might have less internal funding to improve their Tier 1 capital ratios and might thus resort to CoCos for this purpose. And then the last question is, are CoCos considered going concern instruments by market participants? Several papers in the CoCo literature have shown that CoCo issuances lower the CDS spreads of senior unsecured debt. However, that does not mean that CoCos lower the bank's default probabilities, because a CDS spread is affected not only by a bank's default probability, but also by the debt class's recovery rate. Right? So if we have like a one-period CDS spread, if it goes down, it's either because the probability of default goes down or because the recovery rate of the debt class goes up. So a necessary but not sufficient condition for CoCos to be going concern instruments is actually a reduction in the CDS spread of junior debt, because this debt class is junior in the payment hierarchy and thus should react even more to CoCo issuances if CoCo issuances actually lowered a bank's probability of default. Yes, 5 minutes. Okay. So this is the last table I'm going to show you from the event study of CoCo issuance effects on senior and junior CDS spreads. I'm analyzing different CoCo types and their effect on the CDS spreads of senior and junior debt. What we can find is that for all CoCos overall, the senior CDS spreads go down insignificantly, but the junior CDS spreads do not go down, actually. And then for higher trigger CoCos, we see a significant reduction in the CDS spreads of senior debt, but no reaction in the CDS spreads of junior debt. Before I only mentioned that CoCos disappear from a bank's capital structure if they are triggered, but there are two ways that they can disappear. They could either be written down, so they have a principal write-down character, or they could be converted into equity. So for principal write-down CoCos, the combination of a principal write-down mechanism and a higher trigger level results in a significant reduction in the CDS spread of junior debt, and thus those CoCos fulfill the necessary but not sufficient condition of a reduction in the junior CDS spreads to be considered going concern instruments. But for equity conversion CoCos in general, there's a very interesting observation is that the junior CDS spreads actually go up. So if a bank issues equity conversion CoCos, market participants view this issuance as not a good signal of the bank. The junior CDS spreads go up, and that might signal the market participants that the bank was undercapitalized and now issued the least favorable instrument for junior debtors. To conclude, what do I find? I find that minimum trigger CoCo issuing banks take effort to include anything but equity in their capital structure and have lower adjusted Tier 1 capital ratios, and those CoCos are not perceived as going concern capital by market participants, whereas higher trigger CoCo issuing banks achieve higher Tier 1 ratios, but those higher ratios are actually achieved through those issuances, and the CoCos with a principal write-down mechanism may be viewed as actual going concern capital. And since I rarely get the opportunity to talk to central bankers, I want to say that the trigger levels of 5.125% are way too low for CoCos to function as going concern instruments, and those CoCos should thus not be considered Tier 1 capital. Thanks a lot.
Thank you very much for interesting results. So, Salim, this 10 minutes for the discussion. Thank you.
All right, so I'll wait for the slides, but thank you very much for inviting me. It's great to be here again. I like this conference a lot, and I enjoyed reading this paper. So thanks, Tanya, for a great presentation. I'm going to start in the same place that Tanya did, which is the capital stack, which I think is familiar to many people in this room. So capital requirements are not this one number where you have equity and debt. They're a complicated bunch of different things that fit together. 4.5% of it is common equity, fine. We also have buffers for various different risks, like we heard about yesterday, CCYB, for example. We have what are called gone concern or TLAC capital, which is designed to be used when the bank actually fails. And the bank's in resolution, and there's a bunch of supervisory requirements too. What Tanya is focusing on is this, I guess, the one that's one up on my stack, which is the alternative T1. So that's debt which can be converted into equity while the bank has not yet defaulted on the rest of its liabilities. I just want to point that actually it's not just AT1, there are other portions of this stack that can contain Tier 1 AT1 liabilities as well, like the supervisory requirements. They have to be on half equity and half billable debt. So there actually is some discretion exactly how much AT1 is required at the bank level. Okay, so what are these CoCos, these AT1 liabilities? This is the red part of the stack. So they're junior to everything else. They have a write-down or conversion threshold, and to be eligible, as Tanya said, the strike point should be 5.25% of the CET1 ratio. They have to be perpetual, that's the rule in regulation, but they can be callable after 5 years. And in practice, they are called. So banks will call them after 5 years. So really these are basically 5-year bonds with a coupon unless something goes wrong. Okay, that's how to think about these liability. In the regulation, both banks and the supervisors can say, do you pay, do you not pay? So sort of discretion in both dimensions. Okay. So what's the logic of this? So Tanya was sort of talking about this. You think about the bank's sort of payoff structure, debt embeds a put option. The CoCos are going to have a strike price above the point at which the bank will default. And then you have high and low strike CoCos with different points. So the high strike CoCo is going to convert to equity in some form at a higher point on the bank's return on assets. And also, obviously, you could just meet this AT1 requirement of equity as well, right? So Tanya's basic question is, okay, I have a 1.5% of risk-weighted assets requirement, which has to be in the form of convertible debt or equity. I can pick to have a 5.125% low strike CoCo, that's the minimum requirement. But I can also pick to have a high strike CoCo, or I can pick to have equity instead. So I have sort of a capital structure choice when it comes to my alternative Tier 1 capital requirement. Okay, so what do banks choose? Why would they pick equity? Why would they pick a low strike CoCo? Why would they pick a high strike CoCo? And the paper is sort of investigating that question. Okay, so what are the findings? What correlates with CoCo issuance? This is my summary. I hope I got it all right. So basically, minimum trigger CoCos issuers have a lower Tier 1 capital ratio. They're more likely to be in low tax jurisdictions. They issue higher systemic risk. They're larger banks. And their junior CDS spreads do not decline post-issuance. And actually, in some cases, she finds they increase. Higher trigger CoCos, they tend to have similar Tier 1 ratios or superior ones, non-issuers. They have more impaired loans, and they don't have the same tax sensitivity as the minimum trigger CoCos, and the markets have a muted response to issuance. That seems to be different from the presentation, but okay, I'll come back to you on that one. Maybe that's my misread of the situation. Okay, so I like the setting a lot because we have a bunch of theories for why banks are adverse to issuing equity. Right, I've got a whole list there. I could probably write another 10 if I wanted to, from tax shields to various things about deposit markets, government guarantees, ratchet effects, etc. The cognitive cost of your investors holding equity rather than debt. But when you zoom in on this very specific portion of a liability structure, what you're doing is just killing off a bunch of these mechanisms. There's no deposit market power to worry about. There's no government guarantees. We're not doing maturity transformation anymore. We're all thinking about sophisticated investors. Okay, so we're comparing similar liabilities, okay, with increasing similarity to equity. Okay, and also the coupons are observable. So we have like a price, a return that's embedded. So it's nice to think about, okay, what can we learn in terms of these theories from this setting, from these banks' decisions? And I think my overview, my overarching comment from the paper is I would like to have an organizing framework which tells me, okay, we have these various theories of what banks are doing. Can I devise some clean tests from the AT1 issuance decisions that help me understand exactly which choices banks are making? And there's progress on that in the paper, but I think you could be a bit more sharp in terms of getting identification or some clean tests that are going on. Okay, so one example I had is tax shields, so something you do work on in the paper. So the simplistic way of thinking about a banker's incentives is, if my CoCo gets triggered, I'm out of the money, I really don't care. What I should do is just choose the AT1 that maximizes the value of my tax shield, okay? In which case, I actually want to issue a high trigger coupon, because then I can just get my returns out of the bank at a high rate and get the tax shield from that high rate, okay? That's a cheap way to distribute earnings. So actually, the high trigger AT1 is better than low trigger and better than equity. Okay, it's the right thing to do from a tax shield perspective. And actually, there's evidence of this in the paper, that high tax jurisdictions seem to have more high trigger issuance. So it'd be good to see more bank level variation on this. So a bunch of ways of measuring the values of tax shields for a bank. There are various strategies you could employ. So one in particular would be interest expenses. Are they close to EBITDA, for example? Then I would issue more low trigger AT1. But rather than looking at country level variation where there's a bunch of things happening at the country level, zooming on the bank might be more effective. The second thing I want to talk about was the roller convertibility types. So AT1 can be issued with different degrees of convertibility. Tennis sort of touched on this. There can be equity conversion, there can be a temporary write-down, there can be a permanent write-down on the position. And as you sort of go down that list I've got there, you're providing sort of a call option to the investor, which gets less and less valuable. Okay, so if you're doing an equity conversion, there's a full option to buy equity embedded in the coupon. If you're a permanent write-down, that option is lost, right? So a permanent write-down should actually have a higher coupon compared to a equity conversion debt, okay? So what Tenny finds is that equity conversion is the most common, okay? That goes against the tax shield story, for example, so you can sort of rule that out if you think about how banks operate. So the question I sort of had was, why would you issue one versus the other in terms of these different types? Does the customization reflect investor preferences, for example? So we know that sort of liability issues can be quite sophisticated in how they target their investor types. And so it'd be nice to know who are the investors, these AT1s. Are we seeing banks designing securities to cater to their demand? Okay, so that's one story of why these convertibility types would be present. And, sorry, I put a little type, I missed the last bullet point there, but it suggests not bundling across the different types of bonds. It's nice to see results where we split out the conversion types and see whether the results hold within those different types of conversions. So basically my missing line is do more on splitting out the sample. Apologies for missing those last few words. The last point I want to make is, is the AT1 structure an optimal choice or is it a constrained choice for the bank? Okay, so Basel rules are quite prescriptive on what classifies as AT1, as you discussed, but it still grants a lot of discretion to supervisors. So for example, for the Pillar 2 requirement, this is the supervisory buffer, supervisors can actually choose what's the share that's going to be met by CoCos and what's the share that's going to be met by equity. Okay, so that's the quote from the ECB's capital requirement directive. So in principle, a bank can be forced to have its entire Pillar 2 requirement in equity rather than any convertible debt if a supervisor requires it. Okay, so that will naturally increase CoCo issuance, decrease CoCo issuance. It wasn't also clear to me whether supervisors have a say over triggers, right? So can supervisory guidelines be used to enforce higher triggers? And that also may generate a correlation with bank health. So maybe the Basel rule says 5.125, but the supervisors have read your paper and like, okay, this is not a good threshold. Let's insist on a 7% strike or something like this. And that would generate a correlation with bank health. And so one thing you can do is use sort of supervisory enforcement add-ons or Pillar 2 add-ons as explanatory variables for issuance decisions as a way of sort of capturing what supervisors are doing. I'm not sure what the rules are. I couldn't find out myself, but I think something you should investigate. And also there's the question whether investors are concerned that supervisors will intervene to prevent low trigger debt from being issued. Okay, so it's a very interesting paper. I think in terms of my takeaways, 3 comments. Having a clearer organizing framework would help for banking incentives. Like what are you predicting? What are your hypotheses? What's each variable in the regression designed to do? That's how I think about it. And can you actually get towards identification rather than correlation? I would suggest exploiting further bank level variations, so tax efficiency and regulatory pressure, and a differentiation across CoCo design. So loss absorption mechanisms is what I mean, like doing two-way splits and things like this. So a very interesting paper, and thanks for your attention.
Thank you very much. So, Tanya, give you the floor, and if you want to react before we see also if there is any other question.
Yeah, let me react very quickly. So thanks a lot for the discussion and for the time invested reading the paper and providing feedback. I fully agree that a clear organizing framework would be beneficial. This is actual work in progress in the paper, so I have a toy model there right now, and the goal is then actually to have to optimize the trigger level for the bank and by a trade-off of the cost and benefits of that, not that in this case, but CoCo's versus equity. In terms of data, I must say that this data set is very fragile, so it's very limited to what I can test because the data coverage with the public data at least is not ideal. So if and now I achieved the 90% coverage of the CoCo volumes, but if I depending on what I want to test, this data set goes past very quickly, and I have like a very low coverage. And then the point with the distinguishing between the loss absorption mechanisms, I did not mention this in the presentation, but minimum trigger CoCo is highly correlated with principal write-down mechanisms. So 86% of minimum trigger CoCos are equipped with a principal write-down mechanism. So what I can do is I can split the sample in different mechanisms and then run regressions. So once I'm done with updating the data set actually to the most recent years, I think I have higher power to actually do this kind of analysis. So thanks a lot again for the discussion.
Thank you very much. Thank you, both of you. Is there any question from the audience? Yes, Javier, please.
Very interesting paper. Thank you very much. It's very relevant in some of the discussions on simplification. Regulators are seriously considering the possibility of getting rid of CoCos as part of qualifying Tier 1. So this is super interesting. I take your results as, in a sense, mixed in terms of saying whether this is good instrument within the cascade of capital instruments or not. On the one hand, I see that your results support the idea that they are a substitute for other components of Tier 1. But, so in a sense, to me, it's not surprising that they issue CoCos, but they do not increase their Tier 1 ratio. So they are sort of using them as a substitute for common equity. Now, but on the other hand, maybe they are not worse than common equity in terms of loss absorption overall. So there will be no special reason to feel that this is not the right instrument in the capital stack. But just going in the direction of Salim's sort of theory of why a bank might prefer issuing CoCos to say common equity if this were the choice. Most likely the choice is between that and constraining dividends, because most common equity will be internally originated. So I wonder whether CoCos are cheaper because they are easier to price. In a sense, you don't have to evaluate the upside potential of the bank if it is a fixed coupon plus write-down type option if there is default, I don't know, and whether it is a more flexible instrument. So if a bank needs to improve its capital ratio without sacrificing dividend policy, whether this is something easier to arrange than an equity issuance or less penalized by the market than a dividend cut. I think these are directions I would like to explore. Thank you so much.
Yes, you can reply to that.
Yeah, thank you, Javier. For the first point, yeah, I agree that from the analysis it appears that the minimum trigger CoCos are a substitute to equity and not issued on top of a bank's existing Tier 1 capital. And they are a bad substitute if in the presence of bankruptcy costs. So if we have bankruptcy costs and the CoCos are not absorbing losses before the bank's default, then they are a bad substitute relative to equity, actually. And yeah, CoCos, so this is not my paper, but other papers that find that CoCos are relatively cheaper to issue than equities in terms of lower required returns, and that's because that's Modigliani-Miller basically, right? So you have lower required returns because the CoCos are cheaper, and then the CoCos are cheaper because they have lower required returns, but that's just a compensation for the lower risk the CoCo investors have relative to equity investors. In terms of dividend policy, that's a very interesting point, actually. Then there we are again in the Modigliani-Miller world again, where like dividend policy should actually not matter, but it's a very good point actually to think about and maybe incorporate also in the model. Yeah.
Thank you very much. Thank you, everybody. Thank you for the four of you, and I think that there's a coffee break now. Thank you.
Muy bien. Okay, we have to wait a little bit, but now everything is back. Okay, perfect. Thank you so much. Again, let me actually skip most of my introduction in the interest of time because we are starting with some delay, and Denise needs to take a taxi at 1:30, so we should be punctual in finishing the panel as scheduled. So as I was starting to say before, it's an honor to have this distinguished panel here today, talking about housing risk. If you check their websites, they share this very strong research profile with publications in leading journals, with a very ample research experience in policymaking institutions. So I had some remarks on bios of each of you, but I will skip that. So the speakers on my right-hand side had Intertwin, International Monetary Fund, Bank for International Settlement affiliations during their careers. Katerina on my left-hand side is been moving around central banks in the world, including Bank of Canada, Banco de Portugal, and the ECB. And I think they are going to offer us initially some different perspectives based on their research and policy experiences. And I'm really looking forward to seeing which topics come out in the introductory remarks, and then open a discussion between the panelists and also with the audience. So your questions will be welcome in the second or third stage of this session. So without further ado, we will start with Denise, continue with Gaston, and then with Katerina, because this was apparently the most reasonable way of connecting the initial remarks. And floor is yours, and this is the pointer.
Thank you very much. It's really a great pleasure to be here today, and sorry for putting the time constraint on everyone. Thank you to the organizers for including me in this, and also for putting together a very impressive program. It has been really very nice papers, very good discussions the past day and a half. So I will first briefly remind all of us why housing is a special sector. It's different from others. And then I will review the risks in the current junction. What are the risks in housing markets with a global look? I'm not going to talk about specific countries. And then I will wrap it up with some issues maybe we need to pay more attention to collectively. And before I move on, the usual disclaimer applies. These are my views, not the IMF's. So housing markets have a crucial role in the overall economy. Starting with the production side, they are closely linked to pretty much every other sector of the economy. They have strong spillovers. There is, of course, the direct value added from construction when we think about housing, but activity in housing is also linked to other sectors. Real estate services is one. You need an agent in most countries to sell or buy a house. You need the mortgage services in order to finance, but you also need to furnish that house. You need to do renovations, whatever it is. It's really in that sense, upstream kind of sector. But it's also linked to the government sector. Land sales, property taxes in many countries is a major source of revenue for local governments, sometimes federal governments as well, general governments. And this creates very complex dynamics in terms of government finances and housing market activity, and of course the economy at the end of the day. But beyond this business cycle frequency, housing can influence allocation of resources as well, and that has implications for productivity growth, that has implications for potential growth. Why? Well, construction sector, starting from there, is labor intensive, and it has been shown that it also has low growth productivity, but productivity growth potential. So what happens is that when construction grows disproportionately faster than the rest of the economy, it typically signals misallocation of resources, and that can be long-lasting in terms of its implications. Then there's the special allocation question, right? And we have cities, and agglomeration is typically good. It's, like-minded people, certain sectors come together. There are more exchange of ideas. You have more innovation, right? But this type of agglomeration can also have risks, especially in countries where we have very rapid urbanization processes. You can have overcrowding, you can have infrastructure failures. And why do these all matter? Inadequate living conditions have also implications both for households, and you can take it from well-being perspective, and we have seen that during the pandemic. It's not only living conditions that matter for individual households, but also they matter for society. So that then brings me to lack of affordable housing and the social value of housing. In many countries, housing is actually seen as access to adequate housing is seen as a human right, and there are expectations for governments to play a role in making sure that there's access to affordable and housing that meets certain standards. What then does is raises a major motivation for policy intervention, and it also raises very crucial political economy questions that I'm going to come back a bit later. Now, turning to more the financial side, given that we're in a financial stability conference, housing markets are prone to risks, and they have significant implications for financial stability. Why is that? For one, housing is not small potatoes. It's actually one of the largest items in household balance sheets. On average, about 50% of total assets in household balance sheets is housing related, right? And you take it from there, and then it's used as collateral. You can see how big its importance is in the financial sector, just from playing that role. And then what's also important is that pretty much all agents that are involved in the housing decisions, consumption and investment and financing, they are leveraged. Households are leveraged. When you take a mortgage, we're talking about LTV ratios typically between 50 up to 90%, and you cannot have that with any other asset class. You cannot go and tell a bank, okay, I think Apple stock is going to really do well. Why don't you give me a loan with that type of numbers? They will not. But they routinely do that for housing purchase. But the agents involved on the other side, the lenders, are typically banks, which we know are leveraged themselves. So that opens the door, that leverage component opens the door for financial crisis. And to add more to the complexity, the whole financial linkages, is that housing has significant frictions and substantial network externalities. Just to make it very simple example, you cannot sell one room of your house, right? It comes as a whole. So you can sell part of your portfolio, but you cannot sell part of your house. So that lumpiness creates effects, neighborhood effects are all there. And in addition to that, housing is actually very opaque. Information is not easy to come by. Comparison of different properties can be very difficult. All these information frictions then have implications from a financial sector perspective. And it's macroprudential policies that are designed to mitigate, especially this last part, what I have as the last two bullet points there. That's typically the focus, but the implication is generally for the macro economy. Now, with that background in mind, let's look where we are today. Now, during and after the pandemic, house prices actually rose very strongly. And this was especially the case, what you see as the red line there, especially the case for advanced economies. And importantly, this breaks the typical post-recession recoveries in housing markets, right? Typically housing lags, and it has a big correction that coincides with a recession and is slow to recover. we saw quite the opposite dynamics this time around. And what are the reasons for that? Well, we had the shift, the need for space that was related to the pandemic, and also the increased demand from investors in a high environment, but also at least at the beginning of the pandemic, very generous financing conditions as well. But the supply side also mattered. You may remember that we had the spikes in lumber prices, in steel prices that was related to supply chain disruptions, but also the lockdowns. So construction activity was actually quite affected. So you had this clash of increased demand and constrained supply on top of what's already a very sluggish supply response because of zoning regulations, building restrictions, and whatnot. So it's the perfect storm that created the push on prices. But then what we had, of course, is the tightening of monetary policy across the globe, and we saw the house prices stall. In some cases, we saw some corrections. You see it again, especially for the advanced economies. What is interesting, though, is that the correction at the end was quite short-lived. In many advanced economies, we are seeing house prices, real house prices, rising again. And that's a little bit of a surprise. And one question you might ask, is this the type of thing that preceded the global financial crisis? Are we in for a repeat? What is the overvaluation and potential for a correction? What I would say is that the answer is a guarded no. And the major reasons for that is, compared to what happened in the early 2000s, the rise in house prices is not necessarily driven by credit growth in many economies. So we don't have this twin boom of credit going up, mortgage credit in particular, but also house prices going up. And it's typically the combination of the two that creates the problem. And there is no more benign neglect. You'll remember that asset prices were left to their own, but now we have a macroprudential mindset, and the new policy frameworks we have on the macroprudential front, tighter credit standards that we have, greater buffers in the system that we have, they're all comfort points. That said, some countries are, of course, more vulnerable than others, and especially to watch is that institutional investors and NBFIs, non-bank financial intermediaries, are becoming bigger players in some cases. But aside from the financial stability, I'm going to argue there's a bigger problem, an imminent problem that's pretty much everywhere that we're seeing globally, and that's housing affordability. So for much of the post-GFC recovery, we actually have seen housing affordability improving. Why? Because house prices were correcting, right, in many cases, but also interest rates were very low. So the index we're showing here is a very simple one. It's basically trying to capture what is the ratio of typical household income to the income that would be needed for that household to qualify for the mortgage to buy the median-priced home in their country. It's simple, driven by income developments as well as interest rate and house prices, of course, but it still gives you a nice picture and captures the main idea, which is the mortgage finance home ownership. That's the main affordability, the metric in many countries. And the pattern that we had seen in terms of the climb in house prices, that continued, and we had seen affordability still being, quite well, because yes, house prices increased during the pandemic, but so did disposable household income, right? It was actually very surprising how fast it recovered, how strongly it recovered. So it was kind of holding affordability at a reasonable range. But then, of course, came the tightening of monetary policy, pass-through to mortgage rates, and if we hold everything else constant and consider very generous mortgage terms, fixed rate, very long term, and reasonable down payment, not much, but a doubling of interest rates would still mean that the typical household, average household, has to pay 40% more on their mortgage today, just because of the doubling of interest rates. And in some cases, things are even more complicated because you have this, adjustable rate mortgages, and that squeezes current owners with immediate resets, but also potential to be buyers cannot come into the market. And it was shown in one of the presentations, actually, in this adjustable rate mortgages, some of them have not reset yet, right? So we might still have some in the pipeline of this squeeze that's going to be felt by some households. In other cases, we have seen a shift away from adjustable rate mortgages and to fixed rate mortgages, of course, with the low interest rate environment. But now it created a lock-in effect. And this is discussed a lot in the US context, but it's also visible in many other countries. What that is doing is that the households that bought during the pandemic or they refinanced during the pandemic to fixed rate mortgages at 2-3%, they're not moving. They're not selling their homes, right? Even if they may have a reason to, because they cannot then go buy a house at a higher price, but also at 6-7% mortgage rates. And that squeezes supply a lot. It creates mobility problems, right? We talked about misallocation a little bit. It puts a floor on house prices for newcomers. It's much more difficult for them to enter the market. And current homeowners without a mortgage may capitalize on the higher house valuations, but then it can create intergenerational inequity, right? Because these tend to be mostly retirees, older people who have been in the same house for 20, 30 years. Now, this dynamic of winners and losers, of course, happens within the same country, but it can also happen across borders. What we're kind of calling the transnational class of super rich, and most of our real estate investing purposes can come in with cash purchase offers, and that squeezes the local population from getting into the market. And again, so just to give you another statistic, more than a third of poor households, so the lower quantile of the income distribution, are actually overburdened by housing costs, meaning they spend more than 40% of their monthly income on housing, either rent or mortgage payments. And what that does is actually housing, affordability of housing, is a #1 issue in many opinion surveys, ahead of healthcare, ahead of education. So that gets into the radar of governments and policy makers and politicians, of course, and governments are pressed to find solutions to make housing more affordable, but doing so directly may not be practical, right? It means fiscal outlays. It may not be efficient because you need to come up with, allocation and whatnot. Government is not the best one to provide those, maybe. Policy tools like, zoning restrictions, maybe loosening those, but that can be difficult because sometimes it's not the central government that has the right to do that. You have the local governments, the whole local politics coming in, right? And this can be the supply side solutions can be quite difficult, in other words. Then pressed with the demand from the public to do something, demand side solutions come into the picture again. And this typically means debt financed more home ownership that's subsidized by taxpayers in different forms, but it's actually quite common. So I talked about supply a lot, right? So we have done some research. Is it just our impression? We're hearing more and more, supply is so restrained, this, that. So we have done an exercise across countries and going back to the 70s. And I'm not going to get into the details. This is a BIS quarterly review special feature, and that came out in December last year. So the price elasticity of housing supply has actually fallen. In the 70s, 1% increase in house prices would lead to, on average, would lead to an increase in building firms of about 6%. And by the 2000s, the elasticity fell down to 4%, right? And the decline is attributed to tightening in land use regulation, but also lower productivity growth in construction sector. It's just, again, food for thought. The supply elasticity, as you can see in the middle, across countries, there's a lot of variation. You might think, well, that has to do with geographical constraints, but let me just get your attention to two country cases, Switzerland and Austria, which are both, countries, beautiful countries with a lot of mountains, so difficult to build and whatnot, but they have very different supply elasticities. So there's something more than just the geographical constraints there. And what you might think then is that the more elastic the housing supply, the smaller the change in house prices for a given change in demand. And that's actually what we're finding in the last graph there. We find that house prices tend to be less volatile when, in countries where there's more elastic supply of housing. The flat line that you see there is for rents. And that's also interesting, especially for monetary policy. Right? It's basically telling you that house prices would react if there's enough elasticity, but rents do not seem to care whether there's supply elasticity or not. And that matters for monetary policy, but also for macroprudential policy. So I'm just going to finish it by basically a call that collectively we need to pay much more attention to the supply side of housing. In many of our models, we kind of ignore it. We say it's fixed, at least in the short run, and don't think about it, but maybe it's time that we need to. Let me stop here. Thank you.
Thank you very much, Denise. Your thoughts on the supply matters is very thought-provoking and punctual for the situation in Spain, where we feel that there is a clear lack of supply in the current environment. I will wonder later in the discussion to which extent this is an issue for macroprudential policy to directly care or take as an element of the environment in which we have to unfold our macroprudential policies. But it will be interesting to see whether the scope of macropru should go also into making recommendations for the supply of housing. Gaston is next.
Thank you.
I'm going to change the slides.
All right, thank you. Does it work? Yeah. Thank you for the opportunity to be here at this fantastic conference, in this fantastic setting. And I've been really enjoying the different papers and discussions so far. So also in my case, the institutional disclaimer applies. I want to talk a little bit about the cross-country evidence and some research related to the effectiveness of macroprudential policies for real estate in particular, and related challenges. So if you look at the number of the diversity of tools in the macroprudential spheres that are being used, it's quite large. So this is already a little older. I hear it's now over 2,500 different measures that are being used, but it gives you a sense. What I would like to highlight is that those in this classification that I'm showing you here, the household sector related measures are pretty significant. So, and these are mostly related to housing. And this is from a study that the CGFS did about 1.5 years ago. They covered the case studies with a number of 14 countries. That's why this table here shows the sample. But it's just to illustrate a little bit what the combinations are typically of these tools. I mean, broadly speaking, in the sphere of housing, you have on the one hand the borrower-based tools like loan-to-value ratios, debt service-to-income ratios, debt-to-income ratios, and then those that are more focused on the lender side, on the banks, like capital requirement, risk weight requirement, and so forth. One should also keep in mind that supervision typically plays an important role. So I'm not going to cover that, but in the context of housing risk, supervision is active typically and plays an important role. In terms of macroprudential tools, the loan-to-value ratios, LTVs, are the most common tool. There are only two, as far as I know, two income-based tools, the DSTI and the DTI. And other tools are used more rarely, for example, leverage limits on real estate funds or sectoral systemic risk buffer limits. They are used more rarely in the context of real estate and housing. So what have we learned over the last 10 years or so? Well, there is by now pretty strong evidence that these tools tend to work very well. So one problem, obviously, when trying to assess the effectiveness of these tools is that there is an endogeneity problem. Now, these tools are put in place in response to certain dynamics, so it's sometimes hard to disentangle cause and effect. And so recent studies have tackled that endogeneity problem through various ways, sometimes using microdata, sometimes using policy surprises or other econometric techniques to deal with this issue. And these studies, they do find relatively large and highly significant effects, particularly for borrower-based tools. And more generally, there is evidence that macroprudential policy, including these tools, succeed over time in containing the buildup of vulnerabilities. The strongest evidence or the strongest effects come from LTVs, DSTIs, loan loss provisions, and loan restrictions. This is for credit, for household credit. Overall, the effects on house prices are a little weaker, but they're strongest for the LTV and the loan loss provisions. And capital requirements overall have weaker effects, both on house prices and credit. So this is from a meta-analysis looking at a large number of studies and taking stock of the effects, the average effect weighted by the statistical significance. And here you can see that differentiated by measures that use microdata or macrodata and then combined in red. Blue is microdata, yellow is macrodata. That the housing measures, particularly when you look at the microdata effects, are fairly strong. Now, why these strong effects using microdata? Well, partly it has to do with what I was saying earlier, that you better overcome the endogeneity effect with these macrodata. But perhaps it's also an overstatement because the aggregate effects also take into account or they measure leakages, right, and more general equilibrium effects that you don't see when you just look at macrodata. So we know more about the effectiveness, and they seem to be quite effective, but the precise calibration and the quantification of the effect is still work in progress. We have made some more progress for LTVs, where newer data measures not only 0, 1, is this tool in place or not, is it used or not, but the actual size of the LTV. And so we're getting a little closer to an actual quantification that can use for calibration in the context of LTVs, but not yet for most of the other tools. Nevertheless, it's important to try to start to communicate the macroprudential stance within some kind of cost-benefit framework, even if it's imperfect. Some have started to do so, but it's challenging, right? Here, a tool that Javier has been working on quite a bit and has made important contributions, namely using the tool of growth at risk can be useful. That has been starting to be used, but not yet consistently. Let me illustrate a little bit how one can think about it. So this is based on work with former IMF colleagues. So if you look at okay, so this is okay. This is I have a dynamic slides, so I cannot show you all the effects here. But the idea is you have a projected distribution of GDP growth X quarters ahead. You can estimate that with quantile regressions. And then suppose you have looser financial conditions, then that that is good in the near term for growth prospects, but then you have an increase in the left tail of the distribution. That is the risk that you get bad outcomes rises over time. Then the question is, can you, with macroprudential measures, adjust that distribution, influence it in such a way that you reduce those higher left tails or larger left tails? And then you can do this, not only for 4 periods ahead, 4 quarters ahead, or 2 quarters ahead. You can do it for a longer time horizon. So you can predict the distribution over say 2 years, and look at and estimate using, again, quantitative regressions, how those distributions change with imposition of macroprudential tools or not, in reaction to some changed environment, for example. Then you have those, okay, well, now you need to compare them somehow. One way to comparing them is to use a quadratic loss function. So you can use a kind of a standard quadratic loss function where you weight the variance of output and variance of inflation. And we did that, and then we found, using data from 34 countries, that over time, indeed, these losses can be reduced substantially. Here, this chart shows you the comparison of financial institution-based macroprudential measures, FI, and broad-based measures. You see that on the x-axis you have the quarters. On the y-axis you have the change in losses, so lower is better. And you see that these are the cumulative change in losses. And you see that the effects accumulate over time, so that you can improve, at least on this somewhat admittedly ad hoc metric, but widely used metric, the outcomes, the expected outcome. Now, I don't want to oversell this, right? In the sense that there are many problems with these type of estimations. You have to assume many things. As I mentioned, we lack precise measurements of the tools and so forth and so on. But my point is more than selling you a particular technique. Is more to say that this is an attempt to quantify a little bit the overall effects and looking at the cost benefits overall, and further work in this area is, I think, useful to get to also to something that you can communicate better, right? Financial stability is elusive. You cannot see it, you cannot measure it, but you can say, okay, if we take these measures according to our models, the probability of a sharp recession is reduced by X% over the next year or so. That's something that you can communicate, right? So I think that's something that's useful. Let me say a few brief things about governance before I conclude. So, particularly when it comes to borrower-based measures, and Klaas Knot alluded to this in his speech yesterday. It becomes political, it's sometimes difficult to act. There's a bit of an inaction bias. And so what can you do about that in terms of governance? And again, the CGFS did some work on this, and these mandates, these principles that I'm showing here on these slides, they all sound intuitive, but they have also concrete meaning in the sense that it's always useful if you have one institution that's really accountable, that has a clear mandate. It's good if you can pair announcements with the ability to act, right? So here in case of Spain, the Bank of Spain has the authority for banks in terms of a macroprudential policy, for example, and of course, if you have this clear legal basis, that helps to mitigate inaction bias, and if you have operational independence. Of course, the capacity, the technical capacity to measure risk is also important, and the capacity to enforce compliance, and ideally a mechanism to kind of look beyond the specific measures in a broader context. That's why you have often these financial stability councils where fiscal measures and others can be coordinated. So, two more thoughts. There are some tools that make it a little bit easier to overcome this inaction bias. For example, those that you don't need to adjust so much with the cycle. So LTVs, they have the drawback that in boom phases, they automatically look better, right? The value of the houses go up, and then they look better. Whereas the DSTI or DTI, debt service to income or debt to income ratios, they don't have that property, at least not so much, because incomes don't move as much as house prices, at least not in the same cyclical way. So those don't need to be adjusted as much, and that could be an advantage. Already talked about quantitative cost-benefit frameworks, but there's of course many more things to talk about, but we'll have some time in the discussion. Thank you.
Very much, Gaston. Your presentation was clearly complementary in the sense that you have referred to tools that have been used in the specific macroprudential setup, and mention issues that I will also like to retake in the discussion regarding how to justify to society the activation of tools that, because of considerations made by Denise before, could be socially problematic, because some of these tools will have implications for who is able to afford the house under the existing financial conditions. So I think Katerina is going to further elaborate on the affordability conditions and the situation regarding housing risk in the euro area. Katerina, the floor is yours. Yes, and also let's have a pointer. And the change of
Hello, everyone. Do you hear me well? Okay, fantastic. So first, let me start by saying that I'm very happy to be here. It's really an honor to take part in this panel. And in my remarks, I would like to offer a perspective which focuses mostly on the role of borrower resilience for macroprudential policy and the importance of credit market conditions. And as Javier said, I'm going to give a perspective mainly based on euro area. Maybe it's better like this. I felt it was too strong. Okay, anyway. So in my remarks, I will focus on 4 main points. So the first is that housing risks and borrowing conditions are intertwined, and they are both important to assess borrowers' vulnerabilities and resilience, which, as Gaston was mentioning, is one of the main goals of some borrower-based measures. And although in recent times household vulnerabilities have eased, I would like also to stress that elevated uncertainty could actually weigh on future macroeconomic developments. And in this context, borrower-based measures play a critical role in supporting financial resilience in the euro area. Nevertheless, trade-offs between monetary and macroprudential policy might be less pronounced during periods of high interest rates, which is something I would stress on a positive with a positive tone. And so let me start by mentioning that while the ultimate goal of, or the ultimate objective of macroprudential policy aimed at containing housing market risk is financial stability, policymakers usually translate this into more specific intermediate objective. And as Gaston was stressing, borrower resilience is a key target in most countries, including euro area countries. And then there are a few other countries which also seek to dampen the credit cycle or lean against house price exuberance. Now focusing on the euro area, household vulnerabilities have eased in recent years. And on the left here, actually there, what you can see is that this was mainly on account of improvement in financing conditions and debt service capacity, and to a lesser extent to leverage. And looking ahead, our composite indicator of household vulnerability suggests that vulnerability in the household sector are actually expected to remain low. And this easing in household vulnerability actually goes hand in hand with the fact that the financial cycle positions are subdued. And for the euro area, this gap last turned positive in 21, but then quickly fell back into negative territory and has not recovered since then. As you can see on the right, this is our measure of systemic risk indicator, which is also an indicator of the position of the financial cycle in the euro area. And what the chart indicates with different colors is that the downturn in financial cycle reflects subdued dynamics in residential real estate, and in credit growth. But so while the financial cycle is actually expected to recover in this next future, I also want to stress that given the uncertainty triggered by trade tensions and increasing global geopolitical risk, there is still considerable uncertainty about financial developments in the euro area. But let me also stress that even if you just want to have a quick look at the Basel gap, you will still find that most developed countries have a negative gap. This is true in most advanced economies. And before I forget, let me also stress that these are my own views, just in case. Then moving on, so there is a subdued financial cycle, but this is expected to recover based on expectation of the gradual recovery in lending. And when we look at bank loan dynamics, we see that actually lending has finally started to recover gradually in recent quarters. And this is mainly on account of loans for house purchase, depicted in yellow in the left-hand side chart. And so this gradual recovery in bank loans for housing purchases also contributes to a narrowing of the credit gap. And on the right here, I report results from a counterfactual exercise where we compare the gap, we report in the solid line the gap between the realization of loans to households over time and what the model will predict conditional on the actual macroeconomic developments. So the message is that since the onset of the recent hike cycle that is depicted there with on the right chart with the dashed line, household credit growth remains below what you would expect given the macroeconomic conditions. And even at the end of the period, there is currently a negative gap. Now, just to put things into context, when we look specifically at the household sector, that is the solid line, we see that this gap is quite remarkably smaller compared to the credit gap that you would find looking at other type of credit, like loans to firms, or also credit measures that includes loan to non-bank. So bottom line here is that there is still strong credit growth is still needed to close the existing gap. Now, the current recovery in loans is also associated with an recent increase in demand for housing loans. And this is what you can observe on the left chart, where following the decline in borrowing cost, we see that the demand, especially for mortgage loans, has increased. And these are results from the bank lending survey. And here what is reported is the net percentage, we see that the percentage of banks reporting a strong net increase in household loans keeps gradually going up. And this, if you look at the decomposition, it's obviously related to declining market interest rates, but also housing market prospects and consumer confidence play a supportive role in supporting demand for housing loans. Now, most recent surveys, however, point to a decline in household expectations, likely reflecting the current elevated policy and economic uncertainty levels. And this is evident both if we look at the survey's indicators of housing demand, where you see both on real expectation of real estate being a good investment or planned house purchases, you see that it stagnates, or in particular on the right-hand side chart, expectations of access to credit, it's deteriorating. So the credit sentiment is deteriorating, which is also in line with the fact that banks expected the demand for mortgage to grow at the lower rate in Q2. So why I'm telling you this? Just to give an indication that the credit gap, what this evidence suggests is that the credit gap, negative credit gap on household loans in the euro area is still there to persist for a little while, most likely. What survey results can indicate also is the fact that the recent monetary policy tightening actually keeps transmitting. So this here I'm going to show you results from a recent analysis which has been just published as an ECB blog and will also be published as a featured article in the next economic bulletin. And on the left, what I would like you to focus on is on the fact that households in the bottom of their country-specific income distributions are actually those that are more likely to hold mortgages which are set to reprice by 2030. Now, because of that, the micro-simulations of the evolution of the average rate among different groups of households, which I saw in the middle chart, make it evident that poorer and liquidity-constrained households face on average higher interest rate on mortgages, that is the green and red line here, which are set to keep increasing in the next years, even if one assumes that the rate on new mortgages stabilize. That is what's depicted in the blue line. So overall, these facts suggest that this slow pace of mortgage repricing could also have an impact on consumption. And of course, these are model-based results, but when we ask households, and this is one of the doc questions asked in January 25, if they really care about their interest rate on mortgages, what they report is that households with a variable mortgage rate or fixed rate mortgage which is about to reprice are more likely both to make more advanced repayments on their mortgage to reduce their monthly payment and to plan to reduce consumption in the future, basically corroborating the model results. Now, so in this context, the main priority for macroprudential policy continue to preserve resilience. And in the euro area, borrower-based measures, as most of you know, are mostly taught as structural tools. So this means that different from capital requirements, which have a counter-cyclical component, borrower-based measures are not meant to change over the cycle, even if we observe changes in the credit cycle and in household vulnerability. But they are meant to act as a backstop against excessive indebtedness, reducing tail risk. Perfect. But so we know, however, that the cost of borrower-based measures varies across the cycle, and we think that allowing for a constant bindness is actually key. And this is what we observe many countries doing. So in this table here, I'm reporting the measures, complementing Gaston's evidence, I'm reporting the measures recently adopted by banking union countries where they have different limits on LTV, DTI, maturity extension. Obviously, the LTV and DSTI and LSTI are those that are most commonly used. And if you wonder about difference across colors, so the blue is what applies to all borrowers, while the red is what applies to first-time borrowers, and the yellow to the subsequent borrowers. So some countries differentiate on this and others not. And all this to say that in the euro area there has been a huge effort in implementing borrower-based measures to ensure borrower resilience in the last years. And let me just move directly into my final slide on the relation between borrower-based measures during rising interest rates, which, as I mentioned, during rising interest rates, one might think that trade-offs between the two types of policy are more limited. And what we show here, these are results from a recent paper co-authored with Luis Herrera, which is actually here, and who recently joined the Banco de España, and who can answer questions on this slide. I'm joking. And but here I'm just showing a very just partial view of our results. And we have two panels, and consumption and bank net worth, and we look at the impact of rising interest rates, both on consumption and bank net worth, that is depicted by the solid line. And then we run some counterfactual experiment. And the interesting one is depicted by the dashed blue line, where we show that changing the LTV to maintaining the bindiness of the LTV constant over time, it's actually beneficial both for borrowers and doesn't harm banks. So this shows that despite being an instrument targeting borrower resilience, it is important to fine-tune it to ensure to prevent excessive tightness of these measures during periods in which lending standards are already tight for households. And then just as a final remark, we then compare with other type of policies which instead depend on the cycle, like CCYB release. And here we say that this can also be beneficial. However, it is beneficial provided that the banking system remains overall well capitalized and resilient, not unconditionally. And with this, I conclude.
Thank you very much, Caterina. Very interesting to see your complementary remarks on the situation in Europe more recently, and also something that I was going to ask Gaston, because in his methodologies, I think it was clear guidance based, for instance, on growth at risk and possibly some complementary indicators on when is the right moment to activate macroprudential policies for housing risk. But I was going to ask, but how about the calibration of the tools? And I think that Caterina points to quantitative models being a potential approach to the calibration and also to the time management of the tools. You need, in a sense, to be able to run the counterfactual of how, if at different points in time you consider relaxing the constraints imposed by borrower-based measures, what would be the implication. And also, I think this is a field where all our sort of different expertises and methodologies converge. No? We need the microdata to calibrate the cross-sectional impact of the tools. We need the more macro aggregate econometrics to be able to say something about the big picture implications in terms of also of, I buy very much the idea of communication accountability are key in a field that is potentially socially so problematic. So even the independent authority in charge of managing borrower-based tools might find political challenges to activating measures that could damage particular groups of the population, especially the young or the forming families when buying a first home. So now we have limited time, so I'm going to allow each of you to potentially react to the overall discussion or to some questions that I will drop. Feel free to choose your favorite. So out of the needs intervention, I was wondering whether there is a macroprudential angle to intervening on who should own domestic housing units. So will there be a macroprudential angle to saying it is not a good development that non-residents, you were referring to the super rich, buy part of the housing units? Is there a financial stability angle? But if there is, there could be also an angle to controlling an excessive tourist-oriented model of growth. Like in Spain, I think when we estimate demand for housing, we should incorporate the demand for residential solutions for tourists that visit us in millions in a year, how they compete for space with also families that are formed, immigrants that are flowing in. That I found fascinating from your presentation, also talking about the rigidity in the supply. I mean, maybe we should take it as a given, but as analysts, we should seriously wonder what is behind the increase, the reduction in the elasticity to the price of housing supplies. I was wondering whether in the Spanish context and maybe in some other context that you might know, having had a so bad experience in our previous housing boom, which was also a construction boom and took us to our greatest financial crisis in history, has made everybody, maybe in a discoordinated way, to play a very reluctant or hesitant attitude towards stimulating construction as an activity. No? So I think even town halls that had constructed their financing on the basis of getting income from real estate developments, learned the lesson that this income was volatile and could disappear, and now maybe they are not giving permissions for land development, and at many other levels. It could be also bank supervision, so it could be that even bank supervision carries the memory that real estate development loans were among the most problematic in Spain. They were taking down the whole caja sector, almost the whole. Let's be careful. This might matter for the big picture. I had a question related to Gaston's presentation on to construct a framework for macroprudential policy in this setup. We might need to agree on what are the goals and the scope. I mean, this is also connected to my impression that the scope might be broadening if we consider social and political and supply side constraints. But we need to know about the policy trade-offs and the tools. And we have increasing evidence on the implications of the tools. Do we have good indicators for the precise timing of the activation of the tools and at which intensity? What will be the state of the art regarding this? On Caterina, I think you started with a very optimistic reading of the situation of European households. And you were saying that the situation was improving, and you said something like, the conflicts between monetary policy and macroprudential policy are lower in an environment with higher interest rates. Well, once you have got there and you have survived, I agree. But I guess that the transition from extremely low rates to unexpectedly higher rates was very challenging, and it's true that I'm genuinely surprised by how well things have gone in Europe overall, and definitely in Spain. So, but maybe more broadly, no? Have we learned something that is relevant for the next cycle? Where could be the biggest negative surprises regarding housing risk? Let's say for Western countries, although I think that we should have a more global perspective, no, in the incoming years. So in this world of tariff wars and potential depression associated with the potential evolution of interest rate, what will be your major potential flags to try to detect in housing risk developments in the incoming years? Too many questions. Just feel free to elaborate for 2-3 minutes each on your favorite angle.
I will give you some nuggets, and then I may need to run. But the whole list of questions, I guess that's why I love working in housing markets, because there's so many angles, so many questions and still so little that we know, and we continue to learn, right? But let me maybe touch on what you raised in the general, okay, I talk about supply, and I made a plea, please, let's talk about supply. But how does it fit with the macroprudential policy as it stands? I guess I could make 3 points there. First is understanding the supply, what's happening with supply, can help us understand whether macroprudential tools are the right ones to use, right? And we talked about, I mentioned the twin booms of mortgage credit and housing prices. You added the construction boom into that, right? That's the third pillar, if you would. That's typically a recipe for disaster. And in that context, if as Katerina said, in the current environment, macroprudential policy is not loose. Credit is not free, it's not like flowing through, and construction is not booming. And if there are calls for macroprudential policies to tighten because house prices are increasing, we need to say, well, no, the source here is the source problem is supply. And that's not macroprudential policy's strength. It's not what macroprudential policy can do. So understanding the source is one point. And there, perhaps one example is Hong Kong. For those of you who might be familiar with that, they are one of the early users of LTV ratios, and they successfully used it for 4 years. And then there was a period where they would continue to tighten LTV ratios, but house prices continued to grow at a robust rate. And then they figured out, well, it's the mainland China buyers coming in and making cash purchases. So you can tighten LTV as much as you want, but house prices will continue to rise, right? The second thing I would say, understanding not only household ones, but the other macroprudential tools we have, how they are affecting property developers, construction companies. There's a supply end there too, building permits and completions. Are we tightening something when we're not intending it to happen? Just understanding, again, the dynamics, not necessarily we need to adjust things. That's kind of like, monetary policy and inequality argument. We need to understand the heterogeneity in the monetary policy transmission. That doesn't mean that monetary policy should try to redistribute, right? And the last point I would say is related to what I said at the beginning. We use it a lot with monetary policy. Monetary policy cannot be the only game in town. Well, with the same token, macroprudential policy cannot be the only game in town. There are other things, and in the supply context, housing supply context, it's the zoning regulations, it is the social housing, anything that you can think, tax incentives, right? Those are in other mandates, other agencies' mandate and objectives that need to come in. Macroprudential cannot do that. And I think it's a danger, actually, for macroprudential policy to try to something, going back to what Gaston said, in terms of having clarity in objectives and mandate. Let me stop there.
Thank you so much, Denise. And we understand you have to leave. I mean, I think others are not in such a hurry. We started late, so I think we are going to excuse you from being in the panel, and if you agree with that, continue the conversation for a few more minutes. So, Gaston, please. Thank you so much, Dennis.
Thank you, Javier. On your question, as I was highlighting, I think we are not quite there yet in the sense that we can have a calibrated model approach where we can fine-tune and with precision say, if we use this tool, then it will affect the probability of a recession by X or Y%. Ideally we would get a bit closer to that, and then of course it's the judgment, it's the society's policymaker judgment as to when to step in. How risk averse is the policymaker and what are society's preferences in that setting. Now, but we're getting it closer, as I was mentioning. One thing that I did not highlight was that we have also learned that the use of these tools tends to have diminishing returns. So some emerging evidence suggests that if you tighten the screws too much on some of these instruments, then they lose effectiveness, or at least the effectiveness declines. And that has to do probably with leakage, right? And that takes me to the point that most of the tools that are in place currently are bank-based, bank-related, right? So, and in the big picture of macroprudential policy, of course, the growing role of NBFI activities, of non-bank financial intermediation, is a pending agenda. And more concretely, if you think about the real estate market, often nowadays you have real estate funds that buy either housing or commercial real estate. Sometimes they're very leveraged. They're not necessarily subject, or typically not subject to LTVs. So this is beyond housing and beyond real estate, but also in this area tackling NBFI activities, or having at least an eye on them, and possibly acting if needed, is pending on the agenda. Thank you.
That's a good point. As European supervisors commonly claim, we have data gaps as well as policy understanding gaps and policy tools gaps for the non-bank financial intermediation sector. Caterina?
So maybe I will conclude on stressing the fact that in relation to the build-up of financial stability risks, macroprudential policy is, of course, our first line of defense. But as Denise said, this doesn't mean that macroprudential policy is the only policy in town. So it is important to acknowledge that while during low rates episodes, low rates environments, macroprudential policy is there to limit the build-up of excessive risk. In a high rates environment, the scope slightly changed and focus more on supporting resilience and also ensuring that we don't focus too much on the tightening of this policy. As we saw with Luis, it's really important to avoid this unintended excessive tightening of lending standards during periods of high rates. And in general, it seems what our models tell us, Javier, also our joint models, is that it is always very important to consider counterfactuals, because in this counterfactual, what general equilibrium models can tell you is also in which direction the interaction of policies go. So although I agree with Gaston that cannot be the only magic instrument to tell you how to calibrate an instrument, it gives you some important indications on the directions and the interaction of different policies.
Perfect. Thank you so much. Let me open the floor for questions. We will accumulate a few. So please, let's have mics into the room. And Carlos is first.
Yeah, so thanks the panelists for all the discussion. Yeah, I found very interesting in particular the reference to supply, and I think that it's an important topic, but also the model that we use, no? So maybe the neoclassical model, even if we move from vertical to upward sloping, is too simple because maybe there are like state variables such as the existing stock or the heterogeneity of suppliers. And I think that crucially and relatedly, whether there is pricing power or there is degree of pricing power, this is hardly ever discussed or considered in terms of housing. It's considered for other markets, breakfast cereals or such, no, but not in housing, and that can affect the evaluation of, for example, the side effects of imposing the borrower-based measure. So yeah, that's a very fascinating question. And also we are focusing on rightly on cyclical, but maybe also like a structural risk, no? Or for example, when looking to the real price of housing, in particular in Spain, I think in other jurisdictions too, it has increased over time, like looking from long-term perspective from the 80s. And this has certainly conditioned the sectoral composition of the economy. So just that reflection, or what are your thoughts on potential structural risk, like the increase in house prices can stabilize, but if they are like high relative to other goods in the economy, that can impose some structural risks. Thank you.
Any other raised hand? David?
My question is, so I really enjoyed the session. My question is for Gaston. What are your views on the institutional setting of the macroprudential institution? particularly in a monetary union where you might have geographically different natural rates of interest rates? Should it be the central bank? Should it be a centralized institution? Should it be national? What are your thoughts on that in terms of beyond, it has to be independent? Thank you.
We also have Federico.
Yeah, very interesting panel. Thanks. Oh, this is very loud. So my question is for Gaston as well. I was wondering simply about whether there is some clear cross-country heterogeneity in these growth at risk measures following the implementation of macroprudential policies, and also whether how we should evaluate the benefits versus the costs. So the cost would be in terms of less growth, so the other tail basically. Is there any chance of using those tools also to evaluate that? Yeah, thanks.
Okay, I think we can go from here also because we are already eating on our lunch break. So who wants to take questions first?
You have more to say.
Thank you. I mean, on the institutional setup, there is no best solution, right? And in principle, you find following different models, right? You have either the model where you have a central bank that has the main powers, or you have a supervisor separate from the central bank that has the main powers in this area, or you have an interagency macroprudential authority with powers or without powers. It could be just a kind of a consultative one, in which case often the macroprudential powers are split between different authorities. And again, I don't think there is one model that it's best, but there is some evidence that that along the lines that I was saying, that it helps particularly in communication. If you communicate and then you can also follow up with action, for example, right? That makes it much more powerful. There's also evidence, I mean, there's not much literature in this area, but there is some evidence that central banks that also are in a such an interagency financial stability council that they can communicate better the macroprudential action. So there is some emerging evidence on the role of central banks and financial stability committees that supports some of these notions, but it's an area that's still being researched. The other question was on cross-country differences, right, and on the cost benefits. So we didn't see. I mean, we looked a little bit at differences across emerging markets, advanced economies. It becomes a little tricky because then you have the sample size becomes smaller, and you need a lot of data for these exercises. And so that became a bit difficult to do. But regarding the question of cost and benefits, well, in principle, I mean, you can construct your own loss function according to your preferences. I was talking about a standard quadratic loss function where you put a weight on the variance of output and another weight on the variance on inflation, but you could think of other metrics, and then you can compare what is this metric, what does this metric give you if you don't do anything, and then you can compare them with taking specific actions. So in that sense, it's empirical and it has its limitations, but it can also serve a bit as a counterfactual exercise. Thank you.
Thank you.
Just maybe very quickly on the cost. It's like there is lots of analysis on the direct cost and benefits of the implementation of macroprudential policy, and there is a bit more limited but growing evidence also on potential aggregate cost, which one thing that on which I think is still we need to accumulate more knowledge is how this aggregate potential cost affects the distributive effects of this macroprudential policy. Because also going back to the counterfactual analysis, you always see that when there are aggregate costs, also other policies might react. And so understanding in which direction this goes in terms of mitigating the cost for a part of the population or enhancing the benefits for some other, I think is still something we should learn about.
I agree, and I think I think the evidence so far suggests quite consistently that the side effects, the unintended costs of macroprudential measures are fairly limited. So this is good news. So this is what the emerging evidence tends to find. Thanks.
And there is possibly, if I can add, room for fiscal policy to offset some of the redistributional implications at some point. No, I think we should not mix up the need to keep the financial system stable with the need to promote access to housing. In a sense, that conflict could be solved by the fiscal authorities with the right measures. I think Carlos was referring to a very interesting issue on market power. I'm not sure we really know about it. But just one thought that your remark was provoking to me was about who is the monopolist in this context. In some cases, it's the local authorities with their capacity to expand the line beyond or within construction can take place. So I wonder whether we have excessive exercise of monopoly power on the use of land by the corresponding authorities, and that it will be connected to who should be the authority. Whether the local power, which is potentially influenced by the local owners of land, or there should be a more centralized policy as for which lands can be subject to construction or not. I just leave it there. And before we end, I would like to thank our panelists today, including Denise that left earlier, but also the organizers of this very nice conference, Banco de España for hosting and organizing, Rafa Repullo as usual with all the impulse, Galo Nuño and others who were in the background of this very nice conference. As a participant, I have enjoyed it a lot. As a member of CEMFI's faculty, let me also thank everybody else for attending this, I guess, successful event. So big applause to all of you.